the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. A further reduction in the policy rate at the December meeting is not a foregone conclusion.
Which, of course, makes it very difficult for them to begin cutting again in December.
What you see here is a repricing of market pricing to December.
You have a pretty divided committee in terms of the case for preemptive cuts.
Instead of a dual mandate, we have a dueling mandate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Bond markets stabilizing after a hawkish rate cut and a Fed chair who's slowing down in the fog.
We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
Meanwhile, tech earnings highlighting just how high the bar really is, with Meta futures plunging in response not to bad earnings, but simply to big spending plans. And the big story this morning, President Trump calling the meeting with China's Xi amazing, with a host of market-friendly details. Annmarie, definitely catching the attention of a lot of people in markets.
Right. He came out and told reporters at a scale of 1 to 10, the meeting was a 12. It was just simply his words, amazing. So investors can breathe a sigh of relief. Look, soybeans are going to be purchased. Rare earths are going to start flowing again. The fentanyl tariff is going to be cut. But two issues that I think still need to be dealt with. One, the president said there's going to be an energy deal. We're going to be speaking to Secretary Chris Wright. Potentially he can give us some insight into, is China going to be purchasing U.S. energy? And then what happened with the Blackwell chips? The president said Blackwell will be discussed. The president said other chips were discussed, but not Blackwell. And then he said China will be discussing this specifically with NVIDIA. And I think this is where the market will want some clarity.
Absolutely, given the fact that there's been a lot of questions about how much that is on the bucket list for China's Xi Jinping. In the meantime, we did get a Fed chair press conference yesterday, and it seemed like not that he was passing the buck, but saying, hey, government, open up, give us some clarity so we can get out of the fog, and maybe we can act more quickly. Otherwise, we're slowing down.
Absolutely. But to his credit, how can he say we are in a position to cut interest rates in December when they might still be in a data desert, and he is dealing with diverging views on his own Federal Reserve? I love what Zero Hedge tweeted yesterday. Wait, did market expect Powell to say we'll definitely cut in December? Because that's what it felt like going into this meeting. 90% chance the market had for a December rate cut. They got a little bit of dose of reality yesterday.
Yeah, the answer to that is yes. That's what they were expecting, and that's what they're hoping for. And there's a real question of what the benchmark is right now for the Fed. Is it the labor market or is it inflation? Right now in markets, you're seeing a pause, a stability in bond markets and stock markets, a bit of softness pretty much across the board, but just a bit, down 0.2% on the S&P. You are seeing a little bit of a dollar weakness after yesterday's strength. The euro 116.19. 10-year yields having a little bit of a break after rising by 10 basis points yesterday in the wake of that Fed meeting, 4.06%. Coming up this hour, Chris Verrone of Strategas, with stocks holding steady at record highs. Leland Miller of China Beige book as the U.S. and China reach a deal, and Krishna Guha of Evercore with a December rate cut in question. We begin this hour with stocks just dipping just a slight bit despite the U.S. trade deal with China, a rate cut, and a trio of big tech earnings that really are not bad, despite what you might be seeing in some of the shares. Chris Verrone of Strategas, a Baird company, writing this: the market seems more tolerant of rate cuts here. So long as 10-year yields are below, say, 420 or so, the path of least resistance remains lower for rates. Chris joins us now. Chris, thank you so much for being here.
Thank you.
What did we learn yesterday?
Listen, I think what was the language? Far from it was the language that Powell used. It reminded me a little bit of 2018, nowhere near neutral. He has a reputation of being late. I think the bond market knows that. We've seen that with the 2-year yield over the last 5, 6, 7 months. The fact that the market rate still trades, even after yesterday's bounce, call it 75 bips below where the policy rate is, I think is a suggestion that the market wants more. And I think the market wants to be placated here in the December meeting and beyond.
The market always wants to be placated. I think that is an evergreen statement. There is a real question of which market. There are many different markets. The momentum market was the one that really took it on the chin yesterday in response to the disappointment about not getting certainty about a December meeting. Do you think that that has longer legs than just the momentum trade?
Well, I would say first, I would say the most important market here is probably the bond market. And when you think about what the reaction was yesterday of bidding up short end rates higher, I think that was a bit of a mistake. If we get to a point where they don't go in December, I actually think rates fall. right? If this is an economy that's cooling, that's weakening, and they don't cut into that, I think the risk is actually yields fall from here and fall more meaningfully than people expect, and not for the right reason. When you look at the curve's quietly been flattening for the better part of the last 2 months. I don't think the banks have loved that. You've seen that with the regional banks. So certainly there's some hints of weakness there. When you look at the broader momentum trade, I thought last week's hit to gold was particularly relevant in that regard. I think the question out there is, does that begin to bleed into what has really been the main show, the momentum in Mag 7, in tech? I think it's early to make that conclusion.
Especially because earnings came in pretty well, right? I mean, if you think about it, when you start talking about $77 billion of revenue for the likes of Meta, and then you start talking about Crimea River, take out your violin and say, well, you're spending more than you're bringing in terms of the expansion. How much are you seeing that skepticism that gives you a sense that this can keep going for longer than many people think?
Listen, I think when enthusiasm is heightened, when there's animal spirits out there, as a market observer, you have to be particularly on top of the levels. And basically go through Mag 7 through Mag 7 stock. All of them are above the level that I would need to stay constructive on all of them. We'll see where Meta opens this morning. Is probably the one of the 7 in a bit more of a tenuous spot. It actually did correct pretty sharply over the course of the summer. But when you look across the board, I mean, NVIDIA new high, Broadcom new high, Google new high, Apple first 52-week high in 18 months. So the balance of them, I still think, are in pretty good shape here. What happened to gold, I think, was idiosyncratic. All the bells and whistles of a blow-off were playing out in the gold market over the last several weeks. I don't think we've seen that same type of euphoria in equities yet.
When it comes to the Fed, though, isn't Powell correct when he says, how am I supposed to guide and how are we supposed to say there's a December cut when we have a government shutdown? And at the moment, no side is blinking. I mean, we could be December without zero data.
I think there is such a lack of a healthy respect for what the message of the market is coming from the Fed. I would say, underweight the data, overweight what we're seeing both from the bond market and from leadership. The fact that discretionary remains pretty tepid here, the fact that banks have started to weaken here some, I think is the market saying you better go data or no data.
You think the market will push him in December?
I think if we get to the point, so we're at Fed Fund futures right now, about a 60% chance that they go. I think if we start to get to a point through Fed speak over the next couple of weeks where it looks like they don't, the market will push them.
Right now, we're looking also at a bunch of certainty as well. I mean, look, we're going to get into the weakness in just a second, and I do want to get to that because the Chipotles of the world really are raising some red flags about the other consumer out there. I am curious about your take, though, on the China-U.S. deal that was announced. Granted, very few details that actually can be solidified in any kind of inked deal. Nonetheless, providing some kind of framework, bringing down the temperature, talking about the potential that we're not going to get some of the levies on trade, on shipping, et cetera. Does that give you more confidence, or is that just lip service at this point?
Yeah, it does. And I mean, when you think about, I don't think neither Xi nor Trump were really in a position to escalate from here. Go back, what was it, 2 weeks ago now, when Trump sent the tweet that sent markets down 2.5%, 3%. Maybe a little trial balloon there of what a bad deal might look like. But I thought what was interesting that day and beyond, what didn't move that day when stocks were down? CNH was remarkably calm. That's been our barometer into China risk. Dollar CNH has stayed stable the entire time. That's our look at macro risk. When I look at domestic risk, high yield CDX is still really calm here. I think as long as spreads are below, say, 350, the concerns about some developing credit problem here, or through the lens of CNH, some macro problem, are probably overblown.
So I'm trying to gauge whether you're bullish or bearish right now, and it sounds like you're not exactly screamingly bullish on pretty much anything just because of valuations, but you're not yet ready to be full-on bearish. Is that an accurate characterization?
I'm a trend follower, so the trend is up. We've been bullish, we stay bullish, but I just want to be a little bit mindful here. We're in a bit of a window where it seems like the bond market wants something, and I think when you look at what's been a little underwhelming performance from both the banks and discretionary over the last 4, 5, 6 weeks, you do begin to wonder if some of the ground underneath us is starting to shift ahead of 26. I think it's early to abandon any bullish call. The two things I would watch, again, if there's macro risk, it will be expressed through CNH weaker. That has not happened yet. And I think if there's domestic credit risk, it will be expressed through high yield CDX wider. That has not happened yet either.
We look at the bond market and concern for the deficit. There's a chance Supreme Court is going to strike down IEPA. $90 billion worth minimum is going to have to be refunded to companies. How does the market react to that?
I still would be surprised, not necessarily with the strike down, but with the refund call. I think at the margin, one of the reasons that the U.S. bond market has frankly been the envy of the world this year, when you look at what U.S. rates have done relative to Germany or to France, is because of the tariffs.
That's what I'm asking. What if you can't enact the tariffs?
Like, at the end of the day, everywhere across the curve is in a downtrend, whether it's 2s, 10s, or 30s. I think, as we wrote this week, as long as you're keeping U.S. 10s below 420, 425, as long as you're keeping U.S. 30s below, call it 480, 490, the trend is lower.
Chris Verrone, always wonderful to have you. Thank you so much for being here. Chris Verrone of Strategas here in studio. If you do want an anecdote, and there are plenty of them, Chipotle is the one that comes to mind. Yes, it is Meta. Yes, we're talking about getting Amazon and Apple after the bell. But Chipotle coming out and saying earlier this year, as consumer sentiment declined sharply, we saw a broad-based pullback in frequency across all income cohorts, then talked about the ongoing stress in income levels below $100,000. There is a question here about whether this is an idiosyncrasy or whether this really is a trend that's going to deepen into 2026.
They're seeing a consumer slowdown, which is affecting them, but they're also talking about they're seeing higher beef prices, which the president has been tweeting about. We have seen massive uptick in beef prices. It's been a huge issue for consumers. And then at the same time, Chipotle is talking about the impact of new tariffs that are hitting their bottom line. So they are in a very difficult spot right now as compared to other individuals on the high-end consumer level.
Yeah, and the profit margins have been shrinking. The shares responding in response. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. Well, just to flesh out what you've all been talking about, President Donald Trump saying he had a, quote, amazing meeting with Chinese President Xi Jinping that resulted in a trade deal to halve fentanyl-related tariffs on Chinese goods, effective immediately. Trump also said China had agreed to buy U.S. soybeans again. On a scale of 1 to 10, the president said he'd rate the meeting a 12. One issue that didn't come up in President Trump's meeting with Xi Jinping was NVIDIA's Blackwell chip. The president had indicated he might discuss giving China access to the chip giant's most advanced semiconductor. Trump said it's up to Beijing to continue talking to NVIDIA about access to that chip. Shares of Alphabet rallying in the pre-market. The company reported third-quarter sales that topped Wall Street estimates, fueled by a surge in demand for its cloud and AI services. Alphabet said it's investing record amounts to try to push progress in AI. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, U.S. and China strike a trade deal.
I thought it was an amazing meeting. He's a great leader of a very powerful, very strong country, China. We've come to conclusion on many very important points.
China Beige Book CEO Leland Miller joining us next. This is Bloomberg Surveillance. Good morning. Bang up earnings from a number of the tech companies were not enough. Right now we're seeing futures just slightly softer ahead of the open, although clawing back from some of the earlier lows, down at just about less than 0.2% on the S&P. I'm watching the 10-year yield after that 10 basis point surge yesterday on the heels of the Fed meeting. You are seeing a bit of a reprieve, just dipping a slight bit, finding stability here in and around 4.07%. Meanwhile, a big question about Apple and Amazon after the bell, as well as what we're going to see from ongoing bond market stimulus. A question, though, about trade. Under surveillance this morning, U.S. and China strike a trade deal.
I thought it was an amazing meeting. He's a great leader of a very powerful, very strong country, China. And what can I say? We have, it was an outstanding group of decisions, I think, that was made, and we've come to conclusion on many very important points.
Here's the latest. The world's two largest economies reaching a trade deal. The U.S. trimming fentanyl-related tariffs and China pausing rare earth export curbs for about a year. Bloomberg's Tyler Kendall joins us now in Korea, where she has not been sleeping and doing a tour of Asia. Tyler, what stands out from you from this particular meeting?
Yeah, hey Lisa, good morning. Well, it really does feel like that reduction in tariffs for China is the most immediate and tangible impact. President Trump saying that he will cut that 20% tariff linked to fentanyl in half over China's pledges to curb the so-called precursor chemicals used to make the drug. Just for context here, Chinese exports to the U.S. last month averaged about $1 billion a day, and analysts say that number is now expected to go up significantly amid this reduction in tariffs, and also that the holiday season is upon us in the next couple of months, because really at this point the other deliverables that we saw were widely expected or telegraphed beforehand. We got that confirmation that China is going to delay at least a year those newly unveiled export curbs related to critical and rare earth minerals, and also resume the purchases of U.S. agricultural products, including soybeans, though at this point it's unclear how quickly American farmers will see that relief. Also importantly, the U.S. side does confirm it's no longer going to impose fees on Chinese ships that are docked on American ports. That, of course, was a key concession that Beijing wanted to see. Now, two other things that we were closely tracking that I'll touch on quickly. You mentioned this at the top of the program. President Trump saying that he did not discuss China's NVIDIA's Blackwell chips with the Chinese president, though they did discuss other NVIDIA products. That's something we're going to have to track in the months ahead. And then second, the two leaders did discuss ending the war in Ukraine, though at this point, it does not seem like China is any closer to curbing its imports of Russian energy supplies. Lisa, we did get a readout from China's side. It was sparse on details, but did strike this positive tone, saying that there needs to be this cooperation going forward. As for now, these tensions are eased, and both sides seem to be trying to inch closer to signing some sort of broader trade deal down the line.
Tyler Kendall, Bloomberg's Tyler Kendall, thank you so much for all of your work and for that report right now. Leland Miller of China Beige book writing this. The U.S. has, in fact, offered deeper concessions to secure this truce. Once those details emerge, this deal will look far more one-sided in China's favor and perhaps also less likely to hold. Leland joins us now. Leland, why do you say that? What concessions do you see the U.S. offering China to secure this deal that seem lopsided?
I think this is the beginning of the deal, not the end of the deal. So I think what we saw in the last 12 hours was a successful start. The president agreed to pull back tariffs in return for the Chinese agreeing to pull back rare earth, their new rare earth export control regime. A lot of people may not be happy with the shipping fees being postponed, but in general, the low-hanging fruit was addressed. What you didn't see was something that I think a lot of China hawks were scared that they would wake up to, which is a whole bunch of export controls pulled back in some sort of quid pro quo. But again, President Trump announced that he is heading to China early next year, and there will be more concessions, and there will be more back and forth, and there'll be a broader deal that they're working on right now. So we're working on the margins of the deal, and as we get closer to the core, I think that's when things are going to get a bit more controversial.
Leland, what about AI chips? Because the president had said that they would discuss Blackwell. Then he said they didn't discuss Blackwell, but they discussed other chips, and it's now for China to talk about that with NVIDIA. Where does this stand?
I think what the president came to understand over the last 24 hours or so is that this is by far the most controversial aspect of any trade deal. When you start incorporating export control rollbacks, which are done for national security purposes, as part of a trade deal where you're just trying to get China to buy more commodities, this becomes very, very problematic. And so I think what the president realized is that his team needed to do a little bit more research on what made sense here. Obviously, that there's this is a very big issue. But if the president is trying to build up a broader deal, these were the low-hanging branches. And then I think as they work towards the technology side, that's when things are going to get more controversial.
What about TikTok as well? We heard there was going to be some sort of deal regarding TikTok, and all that we heard from the Chinese Commerce Ministry is that they will keep talking.
Yeah, I think there's a general sense that the Chinese side is not completely against any TikTok deal, but I think that they're holding their cards as close to the chest for as long as possible. And so, they can get the maximum concessions possible. Keep in mind, if we would have just announced every concession right now and then President Trump announced a trip to China in April, there'd be this whole scramble to try to understand what that's for. So I think some of the things that people were talking about being released right now are actually being pushed back a number of months. And I think both sides are trying to see what the other side's willing to give before they have a final framework.
So it's a détente for about a year, but that doesn't mean this relationship cannot escalate with any sort of truth that comes out of the White House. What would your message be to investors that think potentially they could ignore this relationship for the next 12 months?
Well, I think, look, an agreement to not do something for a year only holds as long as the Chinese decide they're not going to do something. They don't feel like they've been provoked or something else. So there's an issue that a one-year truce doesn't mean a one-year truce. It means a truce until one of the sides decides that truce doesn't work anymore. But the larger point is, I think, on tariffs. The president's moved back tariffs by 10%. So you have a headline rate of 57%. That sounds going down to 47 or so. That sounds high. You've got an effective rate of around 30%. So I think the larger picture here is they have gone down enough that they're getting very close to what competitor producers are actually being charged in the 20s. Vietnam and the Mexicos and other Southeast Asian countries. If they get too close, all the de-risking work that the president has done will start going the other direction. There will not be an incentive to move your supply chains out of China. So they're going to have to look at that very closely. They're about at the end of what they could do in terms of tariff reductions on China without reversing the president's tariff regime that he fought very hard to put in place.
Leland, the optics of this trip have been pretty powerful. The idea of a Southeast Asia tour in Malaysia and inking some of the deals and the niceties between the likes of the Thai and the Vietnamese and the other leaders in the region, Japan as well. What do you make of that? Do you think that does give the U.S. closer allies in Southeast Asia, that gave it more clout, more ammunition heading into these meetings with China?
Certainly, the more the United States interacts with its allies and partners in Asia, the more leverage it'll have with China, and the smarter policy will be, because you'll be able to de-risk your supply chains outside of things that give China leverage points on your economy. So it's good politics, it's good economics. I think it's very helpful. You look at what happened with the critical minerals. The Chinese released a very powerful export control regime that exerted dominance over the supply chains of the world in terms of rare earths and critical minerals. The U.S. has immediately responded and tried to go out and have partnerships with Australia, with Southeast Asian countries. So I think that what China did was quite momentous, but at the same time, it has lit a fire under the United States to try to do something to fix the problem.
Leland, one thing that China Beige Book does so well is you track real-time economic activity going on in China. There's been a stagnation that we've talked about, unemployment rate for youth very high, and a real question about how much the economic backdrop is going to push Xi Jinping to the table to try to make sure that the relationship with the United States and frankly the rest of the world isn't severed. How well are they doing at rebalancing their economy into more of a consumption, less of just simply an output-based economic model?
The contours of your question are really important, because if you were asking how their economic performance is doing, I would say it's doing well enough for Xi. It's doing well enough. And so I don't think that they feel any pressure to come to the table with the United States. But if your question is, have they been, creating this wave of, this shift from investment to consumption, which they've been promising the last 10 years, no, there's absolutely no sign of that whatsoever. And I don't think you will see that. What you've seen out of the Chinese government is sort of resistance to this. It's been, we got to produce more. We have to export more. We have to continue to use manufacturing and industry as our growth driver. That is running into a buzzsaw, which is global trade friction. So, the Chinese have talked a lot about consumption. They've done very little on consumption. So I think that's something to watch in the future. But, rather than listening to what they say, I would urge everyone to watch what they do. And I think that's going to be very important, because if they do not create the mechanisms to spur up more domestic demand in China, then these trade frictions will never go away. It's not a Trump thing. It's a China thing.
Leland Miller of China Beige Book with some real speak this morning. Really appreciate your time, Leland. Always learn from your insights. And this really does speak to what we're seeing in places like Germany, where economic activity stagnated. And this question of just how many people will coalesce behind this push to get China to shift its model a little bit, to not rely so much on exports.
Well, Europe's waking up to this, because it's not just the exports, it's the investment of the likes of BYD coming in with factories and hollowing out their own industrial base. But it is pretty incredible. And this is the issue the Trump administration has. China's exports have held up even in the face of high U.S. tariffs, because they're just dumping on other markets.
Yeah, meanwhile, we're going to shift to the tech sphere, which is also really key to China. Coming up, Stefan Slowinski of BNP Paribas Exane. As big tech's big spending on AI tests investor patience, plus you hire on it with your morning movers, Chipotle plunging on another sales forecast cut. This is Bloomberg. trying to digest a fire hose of news over the past 12 hours, let alone 24 hours. Right now, futures taking it all in stride, as they tend to do, just down a touch after getting tech earnings, after a disappointment, evidently, from a Fed that is unwilling to commit to a December rate cut at this point, and after what we are hearing with respect to a China-U.S. deal, the contours of which remain a little bit fuzzy in terms of what has to be inked. Right now, you're seeing futures down about 0.2% for the S&P, less than the NASDAQ 100, down just about 0.1%, and the Russell getting a bit of a pop after yesterday, really digesting some of what we heard out of the Fed. Meanwhile, in the bond space, a little bit of quiet after a pretty roaring response to yesterday's Fed meeting and the press conference, where it did seem like this Fed really wanted to push away from the idea of a December rate cut. You are seeing 10-year yields quiet now at 4.067% after yesterday surging by 10 basis points across the board. Even 2-year yields now 3.59%. And gold, let's take a look at gold, because since October 20th, you have seen a 10% plunge in the precious metal. A lot of questions about whether this is actually a tell on some type of geopolitical calm or some kind of trade, but nonetheless, you are seeing stability there too, up about 1.5% this morning. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. It was a blowout quarter for Alphabet. Shares are up 7.7%. The Google parent posted beats across the board, with revenue topping $100 billion for the first time and net income up 33% from the same time a year earlier. All this thanks to surging demand for its cloud and AI services, giving investors confidence that the massive spending it's doing on AI is paying off. But that same confidence did not extend to the likes of Meta and Microsoft. That's why those shares are lower. Microsoft saying that cloud growth is still bumping up against capacity limits, while its beats failed to live up to investors' expectations amid its high valuation. As for Meta, CEO Mark Zuckerberg came on super strong about ramping up AI spending, and that was enough to spook investors after it delivered just an in-line revenue guidance for the current quarter. And we end on Chipotle. Those shares are plunging nearly 20% now in the pre-market after it cut its outlook for the third time this year. They say that diners are pulling back, especially those with lower incomes. So they're going to take a very cautious approach when it comes to any price hikes. It's the latest sign of consumer strain, with the Kraft Heinz CEO saying yesterday that this is the worst consumer sentiment they've seen in decades. Lisa?
Thank you so much, Yahaira. You know, the Chipotle, the Kraft Heinz, to me, that is a story that you have to dig your teeth into and understand, is this a Chipotle problem or is this a broader consumer market problem? And ultimately, that's what the Fed's parsing through, and that's what a lot of investors are too.
It feels like when it comes to these restaurants, though, they're willing to accept the higher input costs. Neil Dutter wrote in, he goes, Annmarie, they're eating the beef prices you just pointed out, which is true. Cheesecake Factory, Chipotle, Starbucks, every single one of them on some point of these earnings is talking about the fact that they are not pushing on price because they do not want to sacrifice what's going on with the consumer.
Happy punny morning, Neil. Thank you so much for that. On our radar this morning, U.S. President Donald Trump and Chinese President Xi Jinping finalizing a truce expected to include tariff relief on Chinese goods for 1 year and a reduction in U.S. duties linked to fentanyl. Elsewhere, Fed Chair Jay Powell warning a December rate cut is far from a foregone conclusion. For the first time in 6 years, the FOMC faced dissent in both directions as differing outlooks on inflation and jobs fuel a tug of war among policymakers. And OpenAI reportedly preparing for an initial public offering as soon as next year. According to the Reuters, the company could target a market capitalization of $1 trillion. Well, this would be one of the largest ever IPOs. An OpenAI spokesperson stated that it's currently not our focus. And Annmarie, it just highlights how big this company has gotten as a private company and how levered the entire tech space is in some ways to the OpenAI story.
On the low end, they're talking about maybe, according to this Reuters report, $60 billion to raise. That in itself would be tremendous, but potentially this could be worth $1 trillion. Interesting, the Reuters report talks about the fact that they want to tap the IPO because it would open the door to more efficient capital raising, enable larger acquisitions using public stock, helping to finance Altman's plans to pour trillions of dollars into AI infrastructure. So guess what? More money going into AI. Very much so. If you're one of those individuals talking about the fact that maybe it's starting to feel like a bubble, maybe it's just not yet. Maybe this will be the top.
Well, the question here is, first of all, OpenAI is worth $500 billion, according to the last private market estimate.
Remember when they were
Yes, startup. I remember that. So then there's this question of, okay, can they reach $1 trillion? Then there's a question of what the appetite is for investors who are getting really tired of some sort of investment plan without a commensurate expansion in profits. And that's what we saw yesterday with Meta. That's what we saw on the margins, a little bit with Microsoft, but that was really just a very high bar. But it seems like people are looking for bubbles, which means that maybe they're getting a little more cautious.
This stat stood out for me. Meta, along with the fellow Mag 7 peers, Google and Microsoft, racked up $78 billion in capital expenditures last quarter. That is basically a 90% increase from a year earlier. That is a crazy amount of CapEx that you advanced just 1 year alone.
So let's build on that $78 billion in combined spending from Meta, Alphabet, and Microsoft. That is just in the third quarter, and the tech giants putting most of the cash toward data centers and chips. Stefan Slowinski covers those names for BNP Paribas Exane and joins us now. Stefan, what did you learn, not necessarily from the earnings yesterday, but from the reaction in markets?
Yeah, good morning, Lisa, and thanks for having me on. So the markets seem to not be able to make up their minds one quarter to the next. Last quarter, we had very strong top-line numbers from Meta and Microsoft, and the stocks were both up very strongly, despite signaling increasing spend. This quarter, we again had very strong top-line results from both of those companies, and obviously those stocks trading down today. So the market's getting a little bit more spooked on some of the spending intentions, especially for Meta. I think the big difference here is with Meta, you have margins, operating margins down around 300 basis points year over year. For Microsoft and for Google, margins are up 200 basis points. So those two companies are being much more disciplined around spending. Arguably, they're much more advanced in their AI partnerships and strategies. And people are starting to get a bit more nervous on Meta with some of the spending that they're seeing.
Stefan, Gene Munster of Deepwater Asset Management wrote this in response to Meta's earnings. Expenses are growing faster than revenue driven by third-party cloud. The last 2 years, it's been the flip story, and this is what he thinks is spooking the market. I'm just wondering, Stefan, what Meta's investing in and whether it could be worthy, similar to what we have seen in previous years from the giant that has changed its name, invested in all sorts of new ideas that haven't come to fruition but still have pulled out pretty impressive numbers and returns.
Yeah, I think when you look at Meta and you look at the track record, certainly what Mr. Zuckerberg is arguing is trust us. You know, we've delivered in the past. Maybe we've been late to some technologies like core AI and now Gen AI, but in the end, we get there. And so stick with us. But the stock's up 680% from the 2020 lows, so investors have done quite well. Like I said, on the spending and discipline investment side, Amazon, Microsoft, and Google are giving you margin expansion and very healthy earnings growth going forward, whereas with Meta, that's likely to slow significantly. And I guess finally on AI, we've seen with Meta this new superintelligence lab that has been sort of cobbled together over the last couple of months. And so there is execution risk there. It's not like what we're seeing at OpenAI. It's not like what we're seeing at Google, where you have a long-established team that's been delivering models and delivering products and launches consistently. With Meta, it is a bit of a rebuild, and so there is execution risk on that Gen AI front.
I was struck by the employee compensation costs. It's now the second largest contributor to the increase in costs that Meta has for next year. Do you think they're going to start to put pause on these million-dollar contracts they're going out to with AI data scientists?
Well, we're definitely seeing those quite expensive hires, but as Meta likes to say, it's a very dense talent pool. So it's not the sort of tens of thousands of hires that we saw from Meta and from big tech back in 2021 post the COVID boom. I think as well, what we're also starting to see is that CapEx hitting the income statement through depreciation. So at BNP Paribas, we've written a lot about this over the last few months, which is that ramping CapEx finally coming through and hitting margins. And so we're seeing that coming through and hitting operating margins. Google talked about a 41% increase in depreciation in the quarter and how that's going to accelerate. But again, you're seeing Google, Microsoft, and Amazon be much more aggressive about managing that, finding savings elsewhere in order to preserve margins or even lift margins and give investors that earnings growth that they want as they wait for that AI revenue to come through.
Does this feel like the third quarter of 2022 where you saw a huge drop in net income and costs rising for Meta, but then the stock ended up going on a tear following that quarter?
I think today you're starting to get a bit of a hint of a worry of going back to the early days of the metaverse, where it feels like Meta is continuing today to invest in the metaverse, where they still very much believe in the opportunity, and they're seeing ramping adoption of goggles and glasses, and they continue to invest there. We see them continuing to invest in core AI, where they're seeing today improvements in their impressions and pricing and user growth because of core AI investments that are working, and now ramping investments in Gen AI, which they see as potentially driving future growth. So I think the market's starting to get a little bit worried, as it did back in 2021, 2022, that the spending is, I wouldn't say out of control, but certainly prioritized spending over margin and earnings after a very good period of growth and margin expansion. We're set to maybe enter a period where margins come down and earnings growth slows down into the single digits.
Stefan, I'm just looking and thinking probably Google CEO and Microsoft CEO and CFO and the whole C-suite is saying, really, Meta's going to take the oxygen out of the air, which we just delivered this incredible quarter, and people are talking extensively about how much Meta is spending. When you take a look at the bottom line of these huge cloud providers, haven't we learned that there still is demand far outpacing supply, and that there still is plenty of money willing to be plunged into the AI hopes and dreams that so many companies still believe in?
Yeah, absolutely. I think there's two things to highlight. One is the core businesses for all these companies continue to perform extremely well. Meta, 24% growth on a $200 billion revenue base. Microsoft is growing 17% on a $300 billion base. And Google just hit a $400 billion base, growing at 15%. And the metrics across the businesses are quite strong. So the core businesses, before we even get into a lot of the AI drivers, are performing very well. And secondly, to your point, on the enterprise cloud computing side, we are seeing Microsoft and Google sold out, not having enough capacity to meet demand. That's where it's a little bit different for Meta, who doesn't have that enterprise cloud computing business. So all of their spend, all of their investment, all of their CapEx needs to drive a return through advertising. Again, they're doing so with core AI, and that's working well. They now need to prove that they can do that with Gen AI. And importantly, they need to prove that they can deliver a leading frontier model that they can plug into Meta AI and some of their other AI services. If not, they're going to end up being reliant on Google or OpenAI or some other partner who is in the lead on the foundational model front.
Stefan Slowinski of BNP Paribas Exane, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The Bank of Japan left its benchmark interest rate unchanged at 0.5%. Two board members dissented against the decision. The yen weakened after the decision, even after Governor Ueda gave subtle clues that a hike could be coming later this year. Shell posted third-quarter profit that beat analyst estimates. The oil giant's performance was led by a rebound in its oil and gas trading unit, even as weaker energy prices weighed on earnings. The company maintained its quarterly share buybacks, marking the 16th consecutive quarter of at least $3 billion in buybacks. JPMorgan has been joined by about 20 lenders, including Bank of America, Citigroup, and Morgan Stanley, in a $20 billion debt financing backing the buyout of video game maker Electronic Arts. Each bank was allocated between 1% and 5% of the financing and will share roughly $500 million in fees tied to the deal. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Putting the leverage back in LBO. Up next, Powell's grip on the Fed.
Schmidt, where was he last meeting? Now you've had more evidence that the labor market is feeling a bit spongier and inflation's not as much of a threat as we thought back in September. And suddenly he reemerges. To me, it tells me that Powell is losing his grip on the Fed.
Krishna Guha of Evercore joining us next. This is Bloomberg Surveillance. Been a huge couple of hours, 12 hours indeed, when we're looking at not only a Fed rate decision that really did leave the market disappointed, but also big earnings from big tech, as well as a deal with Xi Jinping and President Donald Trump. What you're seeing in markets is stability, because why not? S&P futures almost flat at this point after being down as much as 0.2% earlier. You're seeing a little bit of dollar weakness versus the euro, and 10-year yields again finding stability, but just 4.07% after rising by 10 basis points yesterday in just one day. Under surveillance this morning, Powell's grip on the Fed.
I think Myron could have gone for 75 basis points. After all, he wanted 50 last time. And Schmidt, where was he last meeting? Where was he last meeting? Now you've had more evidence that the labor market is feeling a bit spongier and inflation's not as much of a threat as we thought back in September. And suddenly he reemerges. To me, it tells me that Powell is losing his grip on the Fed.
Here's the latest. Fed Chair Powell saying investors need to lower expectations for a December interest rate cut, underscoring hardening divisions among policymakers. Krishna Guha of Evercore ISI joins us now. Krishna, wonderful to have you on the show. Thank you so much for being here. Let's just start with what Bob Michael was talking about. Do you think that this is evidence that Fed Chair Jay Powell has lost his grip over the Fed and that any message is incoherent, incohesive, and not reliable heading into the end of the year?
So I think lost control, lost grip is probably overstating it a bit. But for sure, there are strong signs here that Powell is struggling to manage the committee and finding a strong pushback from a large and vocal hawkish bloc within the committee that really pushed him into signaling that December, to use his phrase, is far from a foregone conclusion. This is now down to committee management. There is no sign to me at all that Powell's own position has changed on labor, on inflation, on policy restraint, on policy strategy. But there is stronger pushback within the committee than we thought. And so this is all about now how he manages this going forward into December.
Krishna, it seems like it's no longer a data-dependent Fed because they have no data. And that seems like what Fed Chair Jay Powell is saying. If you're not going to give us official data, we're going to slow down. We're going to take a pause because guess what? It is foggy out there and risks are on both sides. Is this essentially saying to the government, until you reopen and give us some data, we're not going to do anything?
So I don't really think it's a message to the government. Powell doesn't play games like that. And in any case, the Fed saying, please end the shutdown is not likely to be one of the main drivers of how the shutdown dynamics play out. But you're absolutely right. To zero in on this very striking and in my mind, quite curious idea that if we don't get a lot of new information because of the shutdown, then we should go slow. I think that's analytically completely wrong. I think if you have a baseline view as to how the economy and policy is likely to evolve, aka the September SEP, then if you don't get new information, you should continue along the path that you previously assessed. That's the right way to make policy. I find Powell's idea a little curious, and it seems to me another sign of him straining somewhat awkwardly to accommodate this large hawkish bloc within the committee that was clearly flexing its muscles this week.
From your perspective, Krishna, what should be the more important side of the mandate right now, the employment side or the inflation side? Is it the Chipotle side of the world where we're seeing real pushback from consumers, or is it the Google side of the world where people can't seem to spend enough money?
Well, there's two very interesting but distinct points there. One is speaking to this K-shaped economy that we've talked a lot about, double K-shaped, K-shaped inactivity between the secular AI themes and the others. K-shaped in the consumer between the high-end consumer with the net worth gains and the low-end consumer with slowing labor real income growth. As Powell said in the press conference yesterday, the AI piece doesn't seem particularly interest rate sensitive. That's a secular story, whether you think it's overdone or underdone. So I don't think that he can really try to sort of manage the different parts of the economy. When it comes to balancing the mandate, employment and inflation, I think the reality is that the inflation information, including the September CPI, has been coming in a bit less bad than anticipated. A little reassuring. I'm not saying mission accomplished at all, but a bit on the reassuring side, which logically gives you some more space to lean against the potential for more serious labor weakness to emerge, I think, with another cut in December, which is still my base case, and not by 55-45, more like 2/3, 1/3 coming out of that meeting. But very clearly, that's less of a lock than we thought going in.
Krishna, if they can't guide to December and they say it's far from a foregone conclusion, then why did they bother cutting now?
Well, I think first of all, the market was discounting a cut today, this week, with essential certainty, and it would have been very disruptive not to deliver it. But the logic of continuing to step back towards a more neutral rate setting is as solid in October as it was in September. In fact, it's probably a bit more solid in October because we've had the benefit of that somewhat reassuring September CPI release, while the available data on the labor side has broadly suggested ongoing softness, albeit without any near-term, more serious weakening of the labor market. So whatever the logic for cutting was in September, which is risks coming into better balance, therefore start moving rates back towards a more neutral setting, that applied in October. Logically, if we don't get new information, it will still apply in December. The question is, can Powell drag his colleagues over the line?
Well, Bob Michael, as Lisa stated in earlier on, is saying that he's losing his grip. The Wall Street Journal editorial board calls it Fed confusion, and they think because of this, that the president should announce who is going to be his successor sooner. Do you think we could see that the administration speed up this announcement because of the meeting that took place yesterday?
I mean, it's possible that could be an influence at the margin. Certainly, the timeline we've been told to expect is that Bessent will give a shortlist to the president, by Thanksgiving, and then the president, may act on that, make his selection, after Thanksgiving. So that would certainly line up going into December. If they think the Fed's going wobbly on cuts, it might well encourage them to step that up. But I will say that when you look at the impact of bringing Myrill onto the committee, you've actually seen that, if anything, the pressures have gone the other way, right? Having somebody who is stridently more dovish than the rest of the committee and whose motivations, failure or otherwise, are suspected by his colleagues of being somewhat political rather than purely economic in nature. If anything, it's just making the rest of them more hawkish. Certainly making them more inclined to stand on their independence. And that's not helping Powell actually deliver the cuts. So I'm not sure at all that ramping up political pressure is the way to get the Fed to cut in December. Though I do still think that when all is said and done, the logical compromise is what the logical compromise always was, which was absent new information that clearly changes the story and challenges this idea that risks to labor and inflation are coming into better balance. You cut December, and then you take a timeout to assess in early 2026. That was my base case before. It's my base case now, albeit with somewhat less confidence than it was 24 hours ago.
Krishna Guha of Evercore ISI, thank you so much. Always thoughtful, really interesting. And frankly, on the Stephen Myron point, it was really interesting, and this was something that a number of analysts pointed out, that he did dissent with a 50, not a 75, not a 100. I mean, and it sounds outrageous, but if he was dissenting with a 50 last meeting, why didn't he dissent and catch up this time with a 75?
Hopefully we could speak to him and ask him what his thought process was about his changing of numbers. But it is true that Powell is dealing with a diverging Fed. And reporters asked him about this, and he said, no, it's a deliberative body. It's nice to have different voices. But you have to imagine it's hard to deliver that press conference when you have competing factions on your committee.
Yeah, coming up next to break it all down, Stuart Kaiser of Citigroup, U.S. Energy Secretary Chris Wright on the agreement potentially between the U.S. and China, Edward Fishman of Columbia University, and Sonal Desai of Franklin Templeton Fixed Income. This is Bloomberg Surveillance.
The market continues to underestimate how big AI can be.
The areas that we are more bullish are really around AI.
Earnings are coming in better.
The positivity is going to continue.
I think what happens is over the next year or so, gravity just reasserts itself.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, with stocks processing a fire hose of news over the past 24 hours. President Trump calling his meeting with Xi Jinping amazing. Investors digging into the details. Big tech earnings underway with Amazon and Apple reporting after the bell, and a Federal Reserve unwilling to commit to a December rate cut in the fog of uncertainty that is no data and no agreed upon trend. Is this the Chipotle economy, or is this the Google economy?
That's a great question. I think it depends what kind of consumer you are. Chipotle is saying that they are literally going to eat the beef. Higher tariffs on beef, higher costs on beef has been a problem for the administration, higher consumer costs. But it hasn't been a problem for the Magnificent Seven, which continuously spend when it comes to AI. This stat is amazing. Meta, Google, Microsoft. $78 billion in capital expenditures last quarter, 90% increase from where we were last year, which is why everyone is saying, is there some sort of bubble? Because this is a lot very quick.
What was interesting to me is when you take a look at the Fed meeting, it actually was really interesting. It was expected to be pretty much status quo, and yet the idea of pushing back against December rate cut clearly was market moving. I'm surprised the market isn't moving more on the heels of this announcement between Xi Jinping and Donald Trump. The idea that there is some sort of peace between the world's two biggest economies.
I think part of it is the market went into both the events having the base case scenario. We got the base case scenario out of Xi Jinping and Donald Trump when it comes to soybeans, rare earths, and the tariff level. Pretty much we have a détente for a year's time. With the Fed, Jay Powell and the Fed sprinkled some juice on the market and then quickly took it away with that we are far from December being a foregone conclusion when financial markets going into this meeting had a 90% chance that December was on the table. But I don't understand how they're cutting now if they're not going to cut in December, since we might be in the same place when it comes to fog. 30 days today marks the shutdown.
Yeah, and it seems like maybe talks have some life down in D.C., but we'll find out. I am curious. We are going to be speaking with the Energy Secretary coming up in about 15 minutes. The component here of China buying energy resources from the United States out of Alaska, do we have any sense of what's behind this, how concrete this is, whether this could potentially replace any kind of purchases from Russia?
This is what the president had to say in his Truth Social. China agreed that they will begin the process of purchasing American energy. In fact, a very large-scale transaction may take place concerning oil and gas from Alaska. Chris Wright, Doug Burgum will get on this. So potentially there are some Alaska energy entities or gas, oil that maybe China will be purchasing. This was something new that we didn't know going into the meeting.
And we'll hash that out in just a little bit. Right now in markets, you're seeing just calm pretty much across the board. A lot of news, just all things going on all cylinders, and stability near record highs. S&P futures 69.20 up, down just about, less, really not down, basically flat. We're looking at a dollar marginally weaker, again, basically flat versus the euro. 10-year yields flat after rising yesterday by 10 basis points. Not a lot of action here, even with that news fire hose. Coming up this hour, Stuart Kaiser of Citigroup with big tech earnings pushing equities or trying to push them higher on the margins in certain spaces. Energy Secretary Chris Wright, as we were talking about, with President Trump announcing an energy deal with China. We'll get details there. And Sonal Desai at Franklin Templeton with the Fed chair putting a December rate cut in doubt. We begin this hour, stocks hovering near record highs as investors await more Magnificent Seven earnings. Stuart Kaiser of Citigroup writing this: the early reactions to earnings have been mixed. We remain positive U.S. equity beta with a quality tilt and preference for AI power generation. Stuart joins us now. Stuart, great to see you.
Good morning.
Thank you for being here. I'm glad the polar bears didn't eat you. I'm just curious, going forward, what your takeaway is. Are you still all in on power generation, despite the fact that investors seem a little bit cautious about spending more than revenues are growing?
Yeah, we're still very positive on that story, and I think you're going to get a lot of political headlines next week with Election Day coming up that puts even more focus on utility prices, to be completely honest with you. All the CapEx numbers that Annmarie mentioned, a lot of that is going straight into data center build-out. I mean, one of the meta data centers in Louisiana cost $27 billion, which for New Yorkers, that's 3 tunnels under the Hudson River. It's an astounding amount of money. So, yeah, we're still there. Look, there are obviously risks to that. You know, just one headline that these chips need, less power than we thought would be very destructive for that trade, like we saw with DeepSeek back in January. But for now, we do think it's the best Sharpe ratio way to kind of have that AI trade on.
And frankly, the best example of this is Caterpillar, the fact that those shares popped the most since 2009 on energy, not necessarily bulldozers. I'm just curious what you're expecting to learn from Amazon and Apple and whether that could feed into the story or whether these earnings are irrelevant to you based on the CapEx spend that we've already heard from the likes of Microsoft and Alphabet and Meta.
I mean, definitely not irrelevant. I think Amazon in particular, because you're going to get, a little bit of a sight into AWS, but also consumer spending. So I think Amazon will be quite interesting. I think Apple surprised people a little bit, just given the uptake on the iPhone, but definitely important. Last night was a little more important, and that's how it was priced. But, when the Amazon earnings, I think after the bell will be very important again.
Do you think the bar is just too high, considering what we saw from Meta?
Yeah, Meta's interesting. I think there's some view that their operating cash flows are starting to converge with their CapEx spend, and the question is how are they going to finance that? And the discussion of how do you finance all this build out is a very big one. I think Oracle was issuing about $40 billion in debt this week. So yeah, it's there is a question here I think about how this is going to be financed, medium to long term, and certainly the Meta stuff. It looks like they're all in, and as they should be. I think you both have mentioned the amount of spending. I think it's because these companies view this as existential. They feel like they have to win the AI trade.
You mentioned energy, though. Could the energy story keep up with the spend, or will there be a pause just because we don't have the resources to power this?
That's a good question. I mean, instead of Caterpillar bulldozers, maybe you give your kids Caterpillar turbines. I don't know. But yes, there's an issue with that. I think, look, when Oracle reported, a month and a half ago or so, that was the big commentary, was an amazing revenue forecast. They might not have the chips or the electricity to actually get there. So, our folks on the AI side think you may have to start almost like carving out hyperscalers and have them paying a premium for power, because it does seem like your ability to compete and also your ability to get access to the chips is linked to your, proof of concept on the energy side of it. So, yeah, it could be that we're earlier innings, to your point, because of bottlenecks as opposed to anything else.
How reliant is the energy trade, is the AI trade, on the idea of rates going lower? How much was yesterday's shock that maybe this wasn't an all-in Fed with respect to a December rate cut potentially the first sign of a real problem for this trade?
It hasn't been up until now because these companies have amazing balance sheets and are, generating so much cash. I think the fact that, Oracle is issuing a lot of debt and these numbers are becoming so big, it could be a little bit more of an issue going forward. But the fact is, these are some of the strongest balance sheets on the planet from a lot of these large cap tech. So I don't think rates is going to impact them too much because, frankly, they're willing to self-finance this stuff at levels that a lot of people wouldn't finance them at, because they view that spend as so important, right?
So then why is it important at all whether the Fed cuts in December or not? Because you're talking about how it doesn't affect the biggest trade out there, which has been fueling GDP, has been fueling economic growth. It doesn't necessarily affect the fact that we see credit conditions that a lot of people, for all intents and purposes, have been calling extraordinarily loose. And you've already seen the momentum trade, yes, have hiccups, but do really well. So does it really matter if the Fed cuts in December?
That's a very bullish way to look at markets, I would say, if Fed cuts don't matter for equities. Look, I think it would matter more if we had more data, in the sense that if you could confirm that the labor market was continuing to slow down and they actually wanted to get back to neutral, in that case, it would matter more. We're in a bit of a data vacuum. I think the issue the market's going to have a little bit with the FOMC yesterday is really trying to understand the reaction function here for them in December, because Krishna earlier mentioned this. They had a base case. If you look at the data that's come in since that base case, the inflation data was fairly friendly. They themselves have stated downside risk to the labor market from the shutdown. That combination of data wouldn't suggest that you don't cut in December. So I think the question here is what is your reaction function? What are you going to be looking at, and how are you weighing the dual mandate risk at this point?
So does the market now start to care about the shutdown because it may impact whether or not the Fed can move?
Potentially. The market seems very uninterested in shutdown politics at this point. Look, I think coming into this meeting, you were saying, if we go into the Fed blind, there could be some risk there. The market kind of priced that out. The issue with the next one is they update the SEP, which is another level of detail they're going to have to provide. And frankly, your data at that point could be 2 or 3 months old, depending, because it's going to, if they reopen, you can get 2-month-old labor data out pretty quick. They haven't collected anything on either inflation or labor market data now for 2 months. So it's not like they can just, push a button and get the inflation print. They could go into that December meeting with a lot less information, than we hoped. But yeah, it doesn't. I think you're going to need to see more paychecks miss for the market to really care, to be honest with you.
At this point, though, people are trying to look at what they do have, which is corporate earnings. Mm-hmm. And we've seen pretty varied earnings, right? There's the Chipotle story. I keep coming back to it. I sound like a broken record. No, I'm not obsessed with Chipotle, but there is this feeling they are eating the margins. Insert your pun here, because they cannot pass along any price increases that are commensurate with the costs that are increasing on their end. And they're talking about real weakness, particularly in lower income consumers, at the same time that you're seeing higher end products, in particular first class airline tickets, for example, do really well. So yes, it's the K-shaped economy. At what point Is that weakness going to start bleeding into the credit cracks, the cockroaches, whatever you want to call it, that some people have been trying to suss out?
Yeah, it's a great question. I would say first-class plane tickets, you must be doing very well, Lisa.
I'm not talking about myself, but carry on.
It can be an issue, but look, this has been almost like a slow motion, car crash on the labor side, right? I feel we've been talking about weakness in the labor market for 18 or 24 months. And yeah, there are pockets of risk. Even, Walmart's last earnings, they discussed that, tariffs are going to be an issue in coming quarters. So yeah, there is a build into this, and what we might see is the impact from tariffs, but it's very slow and kind of methodical how it bleeds in. I do think retailer earnings later in the quarter are going to be very important because the front half of earnings have been biased towards larger cap stocks with a lot of exposure to capital markets and a lot of exposure to the AI theme, and those have generally come in well. But look, the market seems pretty happy to whistle by that cemetery, as they say, and until then, markets are going to rally, I think.
Yeah, at that point, it'll just remain anecdotes rather than a theme. At some point, it may tip. Stuart Kaiser of Citigroup, always wonderful to have you. Thank you so much for being here with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The U.S. is resuming nuclear testing for the first time in more than 30 years. In a post on Truth Social, President Trump said, "Because of other countries' testing programs, I have instructed the Department of War to start testing our nuclear weapons on an equal basis. That process will begin immediately." Shares of Chipotle are plunging in the pre-market. The fast casual restaurant chain cut its full-year outlook for the third time this year on weak traffic. The company is also dealing with the rising costs associated with beef prices and the impact of new tariffs. The investigation into the Louvre jewellery heist continues. 5 more suspects have been arrested. According to the prosecutor's office, the 2 men who were arrested last week may have been charged with theft by an organised gang and remain in jail. The stolen necklaces, tiaras and earrings have not been found. That is your Bloomberg Brief. Lisa.
Vonnie, I cannot wait till they make the movie, and I want to see if these are real amateurs. I mean, dropping a crown, I still can't get over that.
It's insane. It's insane. I want to know if they're intact or they've already been sent to diamond cutters and already tiny versions are just spread across the world, and then you're never going to be able to track them down.
That's the worst case scenario that some people are worried about. Up next, not that, striking a deal.
I thought it was an amazing meeting. He's a great leader of a very powerful, very strong country, China. We've come to conclusion on many very important points.
U.S. Energy Secretary Chris Wright joining us next. This is Bloomberg Surveillance. A bit of calm after a whole host of drama right now in markets. Not seeing much action, pretty much flat across the board for the S&P. Futures near those record highs. In the bond space, that earlier gain you're seeing reverse with yields again marginally higher, building on the losses after yesterday's 10 basis point rise in crude. Down about 0.8%, a real détente between the U.S. and China coming to an amazing end, in the president's words, as we did get some sort of deal. Under surveillance this morning, striking a deal.
I thought it was an amazing meeting. He's a great leader of a very powerful, very strong country, China. And what can I say? We have, it was an outstanding group of decisions, I think, that was made, and we've come to conclusion on many very important points.
Here's the latest. President Trump teasing an energy deal with China after both countries reach a tariff and rare earth agreement. Joining us now, I am so pleased to say, is U.S. Energy Secretary Chris Wright from Toronto, where he is in the G7 meetings with other world leaders, talking about energy and what can be done to build out. U.S. Energy Secretary, thank you so much for being with us. I want to start with this deal that President Trump was hinting at with China, talking about Alaska oil. What details can you provide us with? What contours of this transaction do you expect to come to light?
Look, that China is by far the world's largest importer of oil and importer of natural gas. The U.S. is by far the world's largest exporter of natural gas and by far the world's largest producer of oil. So there's so much space for mutually beneficial deals between the U.S. and China. And Alaska was mentioned in that deal dialogues, enormous reserves on the Alaskan slope. They've been strangled by the Biden administration, and Alaskan production's been in decline, but lots of room for that production to grow, lots of room to bring natural gas from the North Slope of Alaska and bring that to all of our allies along the East Asian Rim or, frankly, anywhere in the world. But President Trump is just a master negotiator. He finds out what is it that's critical to the Chinese, what is it that's critical to the United States, and finds that sweet spot of a deal that works for both countries.
Could potentially the United States fill a gap if China decides to buy less energy from Russia, especially since the U.S. government sanctioned Rosneft and Lukoil?
Absolutely. Absolutely. Today, the U.S. produces 50% more oil than Russia or Saudi Arabia. And it just puts not just the United States, but the world in a better position. Can we squish out half of Russian oil exports and still have a roughly balanced oil market? Absolutely, we can.
Have you been in touch as well with your counterparts in South Korea? The president coming back on this trip talked about the tariff rate in South Korea and the plan for them to buy oil and gas in vast quantities, part of that trade deal.
Yes. I've been in dialogues with the Korean staff since I arrived in the office. Korea is a great industrial nation, also short on energy resources, but long on other assets. So, yeah, lots of room for the United States to grow our role in supplying natural gas, oil, and frankly, nuclear technology to South Korea.
I bring this up because it sounds like, are you preparing some sort of trip to the Asia Pacific if you have to meet with your Chinese counterparts and your South Korean counterparts for the United States to send more energy to that part of the world?
I go wherever the president tells me. But yes, I would be going to Asia in a few weeks, and heck, I may be going sooner than that. I'll get debriefed from all the dialogues and all what must be done promptly in the follow-up. Could be heading there very shortly. But I don't know about that right now. But of course, Asia is the center of the world economy after the United States. So yeah, that's a critical alliances, critical partnerships, and critical oil demand sources.
Mr. Secretary, I feel like we should have a map here of all the places where you've got trips planned, because I suspect that you're going to be heading to Greece soon, too, and the whole idea of how much the U.S. is exporting in terms of energy to the European region, especially as they reduce reliance on Russia. Can you tell us anything about how that relationship is developing?
Actually, it's been great dialogues. I think the European nations, the war in Ukraine really crystallized, yes, it wasn't a good idea to have all of our key energy supply coming from Russia. Largest supplier of oil to them, largest supplier of natural gas to them, largest supplier of coal to Europe. And the United States has slid in to displace Russia as the largest supplier of natural gas to Europe. We can do the same thing with oil. And I think we're today the second largest supplier of coal to Europe. So I think there's mutual agreement on both sides there. Certainly there's some regulations in Europe, CSDDD, which is just a way overreach in the regulatory regime that's going to make it sticky to ramp up energy movement as fast as we'd like. But we're in constant dialogue to fix those problems. I'm excited about the future relationship between the European nations and the United States. It's always been good, but I think it's going to grow a lot.
Mr. Secretary, a lot of people who come on this show talk about their concerns about higher energy prices in the United States. They talk about artificial intelligence, the power demands, the inability to really provide the energy that would be required to expand at the pace that a lot of AI giants are talking about. How do you plan to mitigate that? Is there a level at which power prices get so expensive that the United States will reduce some of the exports to the rest of the world?
Well, there are actually different factors that control them. Like our large exports of natural gas today are actually still relatively modest compared to the amount of gas we produce, and we can easily produce vastly more natural gas today. So power prices, the problem isn't the price of natural gas. The problem is the infrastructure, generation facilities, transmission lines. The Biden administration for 4 years forced the closure of a lot of coal plants, a few gas plants, prevented the building of new coal and natural gas power plants. They built a lot of unreliable intermittent electricity that's spread all over the country that takes more transmission assets. All of that goes into the rate base and has pushed up prices. Frankly, it's part of the reason why President Trump got elected. So we're having to reverse all those things. Stop the closure of coal plants. Make it easier to build new natural gas plants. Make new sources that want to come on be successful commercially, not dependent upon subsidies, and not require massive new transmission investments that all just go on to the ratepayers. So we're doing a lot of things at FERC. We had a big announcement last Thursday I probably can't go into here, but specifically aimed at artificial intelligence, how we can speed new firm generation without driving up the price of electricity. I share the American consumers' worries about the recent rises in price of electricity over the last 4 years, and I'm working 7 days a week to stop those price rises and enable the United States to lead in artificial intelligence.
We've seen one of the most significant announcements from this administration when it comes to nuclear. The government is planning this partnership, $80 billion for nuclear reactors, with a Canadian company, Westinghouse. Who will develop them and where? Can you give us more details about this?
Oh, I would call Westinghouse an American company. It's a legacy American company, and it's majority owned by the Americans. It has a Canadian partner in Cameco, but it's an American company. This is a plan to partner across the country at a few different locations to build, as you saw in the announcement, they gave dollar amounts, but a large amount of power. Think of order 10 gigawatts of new electric generating production capacity, and to do it in a way that's efficient. So instead of one here and one starting a few years later, we want to stage in the construction of these plants to most efficiently use construction workers, assemblers, fabrication, so that we lower the cost of nuclear generation, re-stand up the supply chain in the United States. This is quite an exciting project, and more details will come out as we fill in those dots. But President Trump promised to relaunch nuclear energy, unleash a nuclear renaissance in the United States. This is a big part of that effort.
And I wanted to get your take on a reversal we've seen from Bill Gates, someone who's long talked about climate change. He's sort of pivoting his stance. And according to his staff, you recently met with him. Did you have a hand in how now he's talking about energy?
I've had multiple great dialogues with Bill Gates over the last year, at multiple times, and at some length. Of course, he's a very thoughtful, successful entrepreneur, and climate change is a real thing. It's a real challenge. It's just not remotely close to the world's top challenge. And the problem is, by putting it the top challenge, the ineffective things governments have done have raised the price of energy, lowered the reliability of the energy system, and they've stood in the way of efforts to combat hunger, food insecurity, energy security, education, and all the other global challenges. So yeah, look, Bill and I have had great dialogues. He's done fabulous stuff in public health around the world, and I'm thrilled to see him talk in a more candid way about this issue.
U.S. Energy Secretary Chris Wright, thank you so much for your time. Have fun up there in Toronto. Coming up, Edward Fishman of Columbia University as U.S.-China trade tensions ease for now. Plus, Yahira Anand with your morning movers. Eli Lilly shares higher after raising its full-year revenue outlook. You're watching Bloomberg Surveillance. Seeing a bit of stability this morning after a ton of news with tech earnings still on deck. Amazon and Apple after the bell. We did get Alphabet, we did get Microsoft, we did get Meta, and the results were very much mixed. Still, you are seeing gains across the board after reversing some of the earlier losses. Futures up almost 0.1% on the S&P. On the Russell 2000, up almost 0.25%, despite the fact that you really are seeing some concern about the Fed not cutting in December. December. If you take a look at the bond space, it's not necessarily cohering with the strength that we're seeing in the Russell 2000. Yields higher, not lower, building on the losses that we saw from yesterday. 10-year yields up 10 basis points yesterday, and now you're seeing it up almost a basis point again. 2-year yields up just marginally, 3.6%, really raising a question about what the Fed's reaction function is. The dollar had been stronger yesterday on the back of that disappointment about a December rate cut. Now it's a slightly weaker, although basically flat, versus the euro. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. It was a beat and a race for Eli Lilly, so shares are up 4.7% in the pre-market. The company raised its full-year guidance as demand bounced back for its blockbuster weight loss and diabetes drugs. This is Lilly's second upgrade in just a few months, cementing its place as the leader in the weight loss market. And moving on to its competitor, Novo Nordisk, it is upping the ante in the obesity drug race, offering $6.5 billion to buy Metsera and outbid Pfizer. That is why you're seeing shares of Metsera rise nearly 20%. Plus, if certain targets are met, they'd up the offer, topping Pfizer's by more than 10%. It's an aggressive move by Novo Nordisk, taking aim at rivals as it fights to regain the lead. But as we saw with Eli Lilly, it is a tall order for Novo. And we end on eBay. Those shares are down 8.6% after the company gave a profit outlook that missed expectations for the all-important holiday period. The other issue is that shares had run up 60% this year, so investors had high hopes. Lisa?
Thank you so much, Yahaira. That seems to be the story pretty much across the board. Yeah, is it bad or just not absolutely stellar and better than good? On our radar this morning, despite speculation, President Trump clarifying he did not discuss allowing China access to NVIDIA's Blackwell chips during his meeting with leader Xi Jinping. The two did talk about some of the chip makers' other products, but not the highest tech one that has caused the most concern. Meta and Microsoft, meanwhile, as well as Alphabet, announcing plans to increase CapEx on AI over the next year at a tremendous pace, testing the patience of many investors. The three companies spending a combined $78 billion on the AI build-out in the latest quarter. We've got more Mag 7 earnings continuing today. Apple set to report revenue after the close as the company briefly topped $4 trillion in market value Wednesday. Amazon also reporting after the bell, hoping to show investors that its AI investments are paying off. So which is it, the Apple upgrade cycle or this question of the cloud competition and who's winning?
I don't know. I think it's going to be interesting. For Apple, I think it's all priced in because all the channel checks are showing that individuals are going out and buying this new phone. I don't know if it's because Apple's offering something brand new or just people have been waiting so long to upgrade their phone that they're finally like, okay, we'll go out and buy the 17. I think Amazon is going to be more interesting, especially given what's going on with the other cloud computing rivals and an update with them, what's going on with Anthropic. That's really going to be the one to watch. And they recently laid off individuals. So what is the commentary going to be around that?
I'm so glad you mentioned that. Very curious about Amazon coming out yesterday. We reporting, or 2 days ago rather, reporting that they were cutting off thousands of employees, talking about how in the future artificial intelligence would allow them to do that to an even greater degree. How much skepticism do you think there is based on how quickly they have doubled and tripled their staff in response to a tremendous expansion? So this could just be sort of trimming around the edges.
That's what they're saying officially, but you do have to wonder, are they finding ways, thinking about ways? And the CEO talked to us over the summer, how they're going to find ways to trim margins, be more efficient with artificial intelligence. It's not just about productivity. Can you actually use AI to fill a job?
Meanwhile, all I can think about with the Apple upgrade cycle is that when you hear a phone drop, you know the sound of an Apple iPhone dropping, and everyone just wonders, oof, is that going to be the one? I'm telling you, that's like a classic feeling. Maybe it's just me and my kids. Turning to trade now. The U.S. and China reaching a trade deal. President Trump and Xi Jinping agreeing to extend a tariff truce and roll back export controls. Edward Fishman of Columbia University and author of Choke Points joins us now. Eddie, great to see you. Thank you so much for being here.
Great to see you too.
So what was your initial take on this deal or this agreement or this discussion between Xi Jinping and Donald Trump?
Sure. So look, in a sense, we're sort of back to where we started. Trump came out right after he was inaugurated in January with these massive tariffs on China. First the fentanyl tariffs, then eventually the reciprocal tariffs. And basically ever since then, it's just been an effort by the Trump administration to walk those back without appearing to lose to Xi Jinping. To me, the big sort of strategic impact right now is that China has shown the world that its control over rare earth minerals has the United States over a barrel. And what that means is it just dramatically decreases the U.S. influence over China, whether that's on artificial intelligence or even on Russia, where, is Trump actually going to pressure Xi Jinping over Russia? I'm skeptical.
Well, but do you think that this actually pushes the United States to have closer ties with other countries that are dealing with the same issue? It wasn't just the United States. It was also Europe that really was alarmed by these rare earth exports because they were hit just as much as the United States. How much does this sort of expedite this push for the rest of the world to create some barrier between themselves and their reliance on Chinese products?
So that is actually how, if Trump is going to turn this into a win, it's going to be building what some people have called allied scale, coming together with the Europeans, with allies in the Asia Pacific to actually build alternatives to Chinese supply chains. Rare earths obviously would be a great place to start. What I'd say is if you look at Trump's first term, probably the biggest success of his first term was Operation Warp Speed, where rapidly they developed these vaccines that really helped us get out of the COVID pandemic. We need something like that today with rare earths. The thing is, though, we're never going to be able to do that totally domestically, just at home. We're going to need to work with allies for us to fix this problem in any reasonable amount of time.
But is there any appetite for Europe to do that, especially given the fact that they have a ton of climate initiatives, and this is a very dirty industry?
Yeah, look, I agree with you. At the same time, I think that despite those concerns with climate, and I was just in Europe a couple weeks ago, there's a significant concern right now that China basically, again, has veto power over any policy we want, right? Even Taiwan, right? Thank God that didn't come up, apparently, in the conversation yesterday. But there's real fear that American deterrence vis-a-vis China over Taiwan has dramatically decreased because China has shown that it can shut down Ford factories in a matter of weeks if it cuts off our access to rare earths. The thing I'd say, by the way, the U.S. has similar power over the dollar. We just haven't been using that against China. We've been using tariffs, which are a significantly weaker weapon.
Well, what would your suggestion be to the administration to use the dollar?
Financial sanctions, right? So
secondary sanctions on banks if they buy Russian oil, things like that?
Sure. So certainly when it comes to Russia, the key is applying pressure to China, India, et cetera, to tell them that if they keep buying oil from Russia, their banks, their refineries are going to be cut off from the dollar. But even vis-a-vis China, I think Trump's biggest mistake was coming in and assuming that because the U.S. runs a trade deficit with China, the fact that we import more from China than China imports from us, that we would always win a trade war because we could always impose more tariffs on China than they can impose on us. What he didn't anticipate was asymmetric retaliation, that China wouldn't necessarily retaliate just with its own tariffs, but it would do export controls and rare earths. Well, you know what? The biggest choke point in the global economy isn't rare earths. It's the dollar, which is still used in 90% of foreign exchange transactions. And even for China, 70% of its own trade is settled in dollars.
But, Ed, that would be the nuclear step, because that can also have mass implications on the United States and our stock market.
Look, I'm not saying that you would cut off every single Chinese bank from the dollar, but I think if the goal is to establish some level of deterrence with China, to show that we can escalate as well, the area to go is financial sanctions. I mean, if you look at big Chinese companies like Huawei, it's actually remarkable that they aren't under sanctions, right? I mean, we've done a lot to try to cripple Huawei's access to a lot of things, but we haven't put them under sanctions.
But, Eddie, we have seen sanctions placed recently on Lufthansa and Rosneft going in Russia and going directly after some of the biggest oil giants in the region. Do you expect that to be successful? Is that sort of a template of what could be used to come?
Yeah, this is something that I hope, because if you look at Trump's strategy even on India, right, if you go back to August, he wanted India to cut its purchases of Russian oil. So he came out with these massive 50% tariffs on India in August and said, please cut your purchases of Russian oil. Well, the data speaks for itself. In September and October, India increased its purchases of Russian oil. And it's because, again, tariffs are not a significant geoeconomic weapon. India's exports to the U.S. fell in those 2 months, but its overall exports actually rose because it can just sell stuff to other countries, right? But what's happened in the wake of the sanctions last week is we've already seen refineries like Reliance in India and big Chinese oil companies recalibrate their purchases of Russian oil. So I do think you'll see some dip in Russian oil sales in the coming months. Whether it's a durable effect, though, is going to depend on Trump actually pressuring Xi Jinping and Modi and telling them that, look, if you keep doing this, there actually will be consequences for your companies.
You know, it's really interesting to think about it through your lens, through the choke points. We saw the choke point that's rare earth minerals. We've seen the choke point that is energy, especially now with the AI build out, and the choke point that is the dollar. And I want to stay on the dollar, this question of how much what happened in 2022 with some of the sanctions on Russia and this question of seizing assets that were dollar denominated caused a flight from the dollar to eliminate that choke point for other countries. How realistic do you see that flight away from the dollar? Because everyone wants to get away from these choke points and get a little bit more leverage in a world that seems to be controlled increasingly by the people who control these choke points.
I think that's really well said. Basically, if I'm trying to, at a macro level, what's happening in the global economy today, economic warfare is everywhere. When the U.S. weaponizes the dollar, it makes other countries feel vulnerable. They try to insulate themselves. When China weaponizes rare earths, it makes us feel vulnerable. We invest in MP materials and buy, 15% equity in them. So yes, there has been efforts by China and Russia, et cetera, to diversify away from the dollar. So far, the data doesn't really show that those are succeeding particularly well. To me, the biggest risk isn't so much China and Russia. They're always going to be nervous about the dollar. Is Europe concerned about the dollar? Is Japan concerned about the dollar? I think earlier this year, when Trump started imposing economic warfare not just on China and Russia, but against Europe, against Japan, you did start seeing even our friends start saying, wait, we need to sort of diversify. If that is a threat that is ongoing, if our allies in Europe are just as worried about U.S. sanctions as they are about Chinese export controls, then yes, there will be a flight away from the dollar.
Well, you just were in Europe. Whose side are they on?
The Europeans are clearly on America's side. I mean, the Europeans want the United States to be there for them, their ally vis-a-vis Ukraine, and they want there to be the U.S. to be their ally vis-a-vis China. The Europeans are terrified of Chinese overcapacity, too. Look at the European auto industry.
They're not doing anything about it.
On China or Russia? Which one?
On China.
Look, I would agree with you that they haven't.
On Russia.
Yeah, well, Russia. So Russia, because this, I'm glad you brought this up, because on Russia, there's been this narrative from the Trump administration that the Europeans haven't been doing anything on Russia sanctions. Come on. They imposed secondary sanctions on Indian refineries and Chinese banks in July and again last week. So the stuff that in the U.S. we're saying, wait, what, is Trump going to sanction China or India? Europe is doing that. I mean, and actually, they have now drawn China's ire because they've been sanctioning Chinese banks.
Eddie Fishman of Columbia University, thank you so much for being with us today. Really appreciate your thoughts. Always deeply thoughtful. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. OpenAI is reportedly aiming to go public by 2027 with an IPO filing planned by the second half of next year. Reuters reporting the offer could raise at least $60 billion and value the company at up to $1 trillion. OpenAI has just completed a restructuring into a for-profit business, signing a new pact with Microsoft and making concessions to regulators. Meanwhile, dozens have died across Cuba, Haiti, and Jamaica after Hurricane Melissa left widespread destruction across the Caribbean. The storm is on track to reach Bermuda this morning as a Category 2 or Category 1 hurricane. Hundreds of thousands remain in shelters and without power, and the U.S. will deploy disaster response teams to the hardest hit areas. And the Toronto Blue Jays are one win away from their first World Series title in 32 years after beating the LA Dodgers in Game 5. Blue Jays starter Trey Yesavage gave up just 3 hits and 1 run over 7 innings as Vladimir Guerrero hit his 8th home run of the postseason in the 6-1 victory. Toronto will look to clinch the title at home on Friday night. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, casting doubt on a December rate cut.
At this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion.
Sonal Desai of Franklin Templeton joining us next as we figure out exactly how secure that December rate cut could be. No answers, but some speculation. This is Bloomberg Surveillance. Can't keep a record market down. Right now, you're seeing gains on futures ahead of the open, building on already record highs, despite some of the concern on underlying stocks, including Meta, following some of their spending plans that were revealed last night. You're seeing S&P futures marginally up near those record highs, 69.25 across the board. The Russell 2000 doing better, up about 0.25%, which is a mystery when you take a look at the bond space. The bond space continuing to see weakness after yesterday's Fed chair, Jay Powell, came out and said that he is going to drive more slowly in the fog of no government data. Under surveillance this morning, casting doubt on a December rate cut.
My colleagues and I remain squarely focused on achieving our dual mandate goals. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
Here's the latest. Fed Chair Jay Powell giving no guarantees that the central bank will deliver a third consecutive rate cut in December. Sonal Desai of Franklin Templeton writing this. It's telling that Powell quickly shifted the emphasis to December. It was a clever move to distract from the fact that the economic outlook did not really justify yesterday's cut. Sonal joins us now. Sonal, I always love hearing your takes as they are different from what everyone else is talking about. Why do you think it is interesting that they did cut rates this meeting when it was completely expected and baked in to market expectations, given the fact that his rhetoric was a bit hawkish and casting doubt on December?
So thanks, Lisa. It's always fun being here. But here's the thing. What I'm saying here is certainly the market expected it, and the Fed guided us towards rate cuts. So of course they were going to cut. But that's a heck of a response if you're asked, why did you cut? Well, because you expected us to cut. That's really not very convincing. What I was talking about really is that the underlying data, much the way that Powell is telegraphing that December is not a done deal. Quite frankly, yesterday's cut should not have been a done deal either. And what I mean by this is that several people have pointed to benign inflation. I would actually beg to differ. Since the middle of 2023 now, inflation hasn't really come down very much. We've been at about 3%. And it's been over 2 years now that inflation has been stuck at around 3%. Yes, we're down by 0.3% since then. So inflation isn't actually actively coming down. And if it's coming down, the speed at which inflation is coming down is glacial. In terms of the labor market, there aren't very good signs which indicate that the labor market is doing poorly. Powell indicated, he talked a lot about the supply issues. That's absolutely correct. I fully concur with this. There was a Dallas Fed paper which talked about 30K as being the new break even. Based on current ADP rolling 4-week numbers, we're looking at 55K for this last month. So if anything, the labor market's doing rather well.
So at this point, you think that it might have been a mistake for them to cut rates by 25 basis points. Where do you see it showing up going forward? Right now, markets are not expressing concern. If anything, they're responding more to the lack of a December rate cut. And you're not seeing the move that we saw last year when they cut rates and you saw long end yields rise in response.
So I wouldn't go as far as, this is within what I would consider the margin of error. If they took it to 3%, I think it would be a mistake, given the current state of the economy. I think 3.75, 4, I think it should be 4. They've cut to 3.75. It's not catastrophic. In terms of why the market has not responded in the same way, I think with complete You can make the argument, very strong argument, that whatever else you think about last year's rate cuts, those 4 rate cuts came against the backdrop of meaningfully higher inflation and lower unemployment and somewhat stronger growth. So it was a particularly odd time to deliver the size and number of rate cuts they did. Nonetheless, if we look at where we are today, the Fed is standing on the cusp of a first quarter, which potentially is going to see tailwinds for both GDP and for inflation. Small tailwinds coming from, say, tariffs on the inflation front. And from the GDP front, we finally start seeing the impact of the big, beautiful bill on taxes. And I think that that's something which the Fed must take into account as we look forward. So I don't think that the December rate cut is a foregone conclusion. And I think potentially if they cut in December, it's a pretty risky thing to do in front of what we know is going to happen in Q1.
What do you need to see between now and December to then in your mind think, okay, they should be and will be cutting?
I think it would basically be that weakness in the labor market, so we should, and really, yes, it does depend on getting some data. And I know we've got problems getting the data, given that the government is still shut down. But there are other higher frequency indicators we can look at. We also have earnings reports which continue to come down. If the mass of those earnings reports starts moving in the direction of pointing to a significantly weaker consumer, and here I would be looking in particular in areas such as airlines, the consumer dependent pieces of the economy, which actually continue to show strength. And so if we started seeing a mass of data moving in that direction, sure. I also actually do understand why, if they don't have more meaningful data showing significant weakness, they would err on the side of not cutting rather than cutting, because we do know that those SALT tax deductions are going to go up in the beginning of next year. Child tax credits are going to go up. A lot of the pieces of the big, beautiful bill, which are not being discussed today, actually go into play as we start off in the next year. So I'm not sure where the gloom about the economy comes from, because we get fiscal tailwinds pretty early in 2026.
Sonal, just quickly here, we've got about a minute. Meta just put out this announcement that they're announcing a $6 dollar bond sale following their earnings report yesterday. It follows what we saw from Oracle last week. There's almost $40 billion of debt being sold. I'm just wondering if that makes you concerned about the investment grade space, given the glut of AI-related supply coming to the fore.
I don't think I'd go as far as saying we are concerned. The fact is the market is currently absorbing it. Spreads are very tight. It probably makes sense for these companies to issue. But I would say that overall, we're starting from a position where credit is priced pretty close to perfection. Not much scope for error.
All right, Sonal Desai of Franklin Templeton, thank you so much for your time. We always love your insights at a time when people are trying to parse out what exactly the Fed is going to do, and this glut of issuance that just keeps coming to the fore. Annmarie, this idea that Meta is going to have a 6-part bond sale. We still don't have a total dollar amount, but this follows what we saw from Oracle, and increasingly leverage just slowly percolating in, albeit at the investment grade side, but really creating a lot of supply.
Yeah, zero hedge. Someone has to pay for the CapEx. That's what's going on right now. And you're going to see potentially more of these companies that are spending so much on AI have to hit the debt market to finance a lot of this.
Yeah, and what you're seeing right now is a bit of concern, especially for the likes of Meta, that their spending increase is rising faster than the increase of their revenues and their profitability. And that's leading people to think, okay, leverage has to be built in more. The model for some of these companies has gone from asset light to not so much. And that is what I think a lot of people are looking at. Coming up next hour, Tom Kennedy of JPMorgan Asset Management on that Fed decision and beyond. Walter Piecyk of LightShed Partners with Amazon and Apple reporting earnings after the bell. Nela Richardson of ADP and Kelly Kowalski of MassMutual from New York. This is Bloomberg Surveillance.
The Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. A further reduction in the policy rate at the December meeting is not a foregone conclusion.
Which, of course, makes it very difficult for them to begin cutting again in December.
What you see here is a repricing of market pricing to December.
You have a pretty divided committee in terms of the case for preemptive cuts.
Instead of a dual mandate, we have a dueling mandate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, with futures trying to eke out small gains, really fluctuating between gains and losses on the heels of a fire hose of news. Bonds falling yet again after yesterday's Fed rate decision. And Apple and Amazon on deck reporting after the bell, after investors showed increasing concern about the scope of AI spending. But to me, this really is the key question. Can this pillar of the market keep generating the optimism that we're not seeing in some other pockets of the economy?
And Meta this morning saying they're going to tap the debt market because of it. I'm still struck by this quote, the $78 billion in capital expenditures from some of these companies, and 90% basically increase from where they were last year. And that is why everyone is concerned. Meta specifically, though, there is some concern that the bar was just too high. Everyone is very exuberant going into these earnings. So potentially, can they this afternoon everyone get a little bit disappointed because they're just too excited and the bar's just set too high.
Yeah, and with Apple, for example, those shares up some 30% since August because there is this upgrade cycle that people are talking about. And honestly, it is true. We all drop our phones, they break, and we try to put it off for as long as possible because we don't want to spend $1,000. But increasingly, it does seem like the evidence is pointing to an outperform there. I'm just wondering, looking at that bond sale coming from Meta, it does not seem like this credit market is closed, is completely compressed, is feeling the strains of a Fed that's not going to cut rates in December, is it?
No, I know that what Jay Powell said was it's far from a foregone conclusion, and he is dealing with these double dissenters on either side at the Fed. But most people you talk to are saying that even if we don't have a government data, because we're 30 days into shutdown, no one's blinking, the private sector data is going to basically line up in order for them to cut interest rates. So I think the market had a quick reversal because they weren't expecting Jay Powell to go as far as to say that. But at the same time, they're looking at it and saying our likelihood, if we had to take a bet, is that he's going to cut interest rates.
Yeah, people are concerned that maybe we won't get the rate cuts that we're expecting. This is not a market that really is feeling the strain based on the M&A activity as well as the bond issuance. Right now in markets, you could see equity futures just trying to eke out gains, but fluctuating here near a record highs, 69.20, down just a touch. You are seeing, again, that 10-year yield. I keep focusing on that because it was lower earlier today, given the fact that we saw a 10 basis point rise yesterday in the wake of that Fed Chair Jay Powell press conference. And today, you're seeing those losses build, now rising about 2 basis points and crude lower just marginally. Watch this space, especially as China and the U.S. come potentially to some sort of agreement. Coming up this hour, Tom Kennedy of JPMorgan Asset Management as markets digest a hawkish Fed rate cut. Walter Piecyk of LightShed Partners as we look ahead to Apple's earnings after the closing bell. And Kelly Kowalski of MassMutual as Fed Chair Powell puts a December cut in doubt. We begin this hour with bond markets trying to find stability and losing its footing following the Federal Reserve's decision to cut interest rates for the second meeting in a row. Fed Chair Jay Powell warning another cut this year is not guaranteed. Tom Kennedy of JPMorgan Asset Management writing the following. I think conventional wisdom is that the government shutdown is a reason to cut in December, but Powell seemed to suggest it was a reason not to cut. Tom joins us now. Tom, I'm so glad you put this out there and it's great to see you.
Good to see you.
I'm looking at this and I'm thinking, is this Jay Powell coming out and saying, all right, government, get off your butts, do something, give us some data, and we can do something with it. Otherwise, we're driving in a fog. We need to slow down.
Yeah, I don't know. Good morning. I don't know if he was actually trying to make a political statement with that or more about we don't know what the data is going to do. We don't know what will happen. We haven't seen data really for 6 weeks at this point, if you think back into September. And I think what he's trying to say is if we don't know anything, we have to just be a little bit more cautious. Now, I'm sure the team at the Fed has spent a lot of time with JPMorgan, but we should spend even more time because we always have a pulse on the economy, given that at least one product isn't over 50% of households. So we get a great pulse on what's happening.
So we get to spend some time with JPMorgan. So why don't you tell us what you're seeing? I mean, we've been talking all morning about Chipotle. We've been talking about this sort of divergence that we're seeing between Chipotle and Delta. You know, which is it? What are you seeing in the broad scheme of things?
Excellent. I mean, the data is what's going to decide what happens here. I think it's mostly about the labor market. Again, we get great intel on the consumer. When you look at spending over the last 30 days, spending has undoubtedly cooled. We're running on a year-over-year basis about 3%. But under the hood, what's really interesting is that necessity-based spend is what's driving the slowdown. That might feel odd, but it's part of this K-shaped economy that we're living in. Spending growth for high-income Americans is growing, and yet where it's slowing is in lower quartile income Americans. So I think that's going to be a big challenge for the Fed. Where do they come out on that K-shaped economy? What's the most critical, which I think is not being talked about enough, is in our data, we don't see unemployment insurance claim payments going up just yet. So it is this low hiring, low firing economy. And I think that's part of what Powell's worried about. Like if the labor market slows down too much, we will see some of these layoffs, but we don't see it yet in our data. So that's, I think, the data set we're at, whereas the world is slowing down, but hardly an emergency.
When you talk about the consumer spending slowing down, especially in these necessities, would an interest rate cut actually help that?
Yeah, lower interest rates should help in aggregate. And what is it going to help do is stimulate financial activity and also just make day-to-day payments, maybe on credit card payments, a little bit lower, less expensive. So it will on the margin. Annmarie, I think you're getting at a point. This 25 basis points here, they're really too much? I don't think so, but it's the signal about what will happen. On your program, you guys have been talking a lot about how rate coming down is helpful, but also interest rate volatility has come down so much. And that's something that should stimulate financial markets in addition to rate cuts. So coming back to the 10-year Treasury rates moving up so much is kind of interesting. Yeah, we're calling into question December, but it also put a little bit of volatility back into the market. The MOVE index, as your best proxy for interest rate volatility, is below the level it was when the Fed started hiking rates in 2022. So we've come a really long way. It's been a long time, though.
You're saying that basically this government shutdown is giving them an excuse to potentially hit pause in December. Even if we reopen tomorrow, what kind of data clarity do you think we'll even get from the government? How messy do you think it'll be?
No, I don't think it should be messy. And it's really just being delayed because of folks not working. There's an operation behind there where the data can come through pretty quickly.
But they're not collecting it right now.
Well, we're going to be able to collect that data relatively quickly. And yes, the weeks, to your point, the weeks of figuring out where the labor market was will move and shift, but the process is there and can be engineered quickly. Relying on these other data sources is what's going to matter. To the point, though, everything to me is about the labor market. I don't think the inflationary environment, and Powell did this a few times yesterday, the service-based inflation, which is tied to the labor market, is cooling and is consistent with 2%. And if he really believes that tariff-based inflation is somewhat transitory or a one-time shock, which I think Wall Street does too, that's the thing he should focus on, the labor market.
At this point, you said that a rate cut would ease financial conditions. Do they need easing?
Yeah, I think they do.
How do you explain that, given the fact that we're seeing issuance surge, that you're seeing froth in certain pockets, that you're seeing concerns about cockroaches, companies that are getting money that maybe don't deserve it or can't repay it?
Yep.
How do you square that circle?
I think the real estate market is the easiest way to make this analogy. For the last 3 years, what you've had is debt yields higher than equity yields. It's an upside down, inverted capital structure. How can I get a better return with less risk than the equity market in the same capital structure? It can't last forever. You're just pulling up all of that investment out of the equity market into the debt market. This can only coexist where what happens in this world, transaction volumes just fall off a cliff. Private equity is going through the same exact thing. To get the economy moving again, you actually need to higher returns in riskier assets. You're right. There are certain pockets of the market where financial markets are completely open. These are the best businesses in America. But most of America is not the best business. And getting access to the market, they actually need financing and equity returns.
I understand the point about housing in particular. It's moved sideways, and you've actually seen losses in a number of places. Affordability is incredibly low. But what we saw yesterday was curious from the Fed. Because, yes, I understand about the rate cut, but quantitative tightening was going to end, but they were going to allow mortgage securities to roll off and replace them with T-bills, which on the margins should push up borrowing costs for mortgages. Doesn't this go counter to the whole plan of trying to help ameliorate the areas that have felt the most pressure from the current rate regime?
Yeah, yes. In theory, I think it is. But I think the bigger issue is that just rates are higher. The other part about moving from MBS into Treasuries has been a part of the plan for years. I don't think yesterday there were a bunch of surprises. I don't think suggesting the reinvestment risk will go from MBS to Treasuries was really a surprise. If you believe some efficient markets, then it should have been already priced in. When you look at mortgage spreads are tight. I mean, there are financing activity on our platform where these are great commercial real estate properties, and they're being financed at a spread under 100 basis points. If you have a great asset, you can access the financial markets. Haves, this K-shaped economy, is just yet another piece of evidence that shows you there's haves and have-nots.
So I want to finish up with this idea that the Fed did disappoint the markets with December, but you are seeing 10-year yields sell off. Mm-hmm. That doesn't really speak to this belief in markets that we really are facing off real economic weakness. Yeah. It just makes people feel like the Fed's not going to play their game in the same kind of way. How do you square that? What's the message right now from long-end treasuries?
I think the message from the long end is that there's so much uncertainty what's happening here. We had gotten so confident that the Fed was going to be on this risk management process, which historically is small cuts, 3 meetings in a row. Like, when he uses those words, that's what I hear. 25 basis point cuts, 3 meetings in a row. And he just put some volatility into that. And the long end, I think, is telling you there's more uncertainty than when you thought yesterday. But the bigger one is what you're saying. I'm not really worried about the economy. If things get worse, the Fed will respond and cut aggressively. And I think that really helps support why credit spreads are so low, why equity markets are near all-time highs.
Tom Kennedy, thank you so much for taking the time. Have fun with Halloween with your little unicorn, who's adorable. Tom Kennedy of JPMorgan Asset Management here in the studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The U.S. is resuming nuclear testing for the first time in more than 30 years. In a post on Truth Social, Trump said, because of other countries' testing programs, I have instructed the Department of War to start testing our nuclear weapons on an equal basis. That process will begin immediately. Shares of Eli Lilly rising after the company reported third quarter earnings that beat Wall Street estimates. Total revenue grew 54% year over year, driven by volume growth from weight loss drugs Mounjaro and Zepbound. Lilly also boosted its full year guidance. Some sweet and sour news from candy maker Hershey. The company raised its full-year outlook as higher prices bolstered the candy maker's performance, a sign that Hershey is benefiting from the decision to raise prices by double digits back in July. But the company warning that early U.S. Halloween sales disappointed. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. So it sounds like people are going to pay up for their candy, but that's maybe the reason why we're not buying as much Halloween candy. Just suggesting.
I'm giving out goldfish.
You're that person?
No, because they glow in the dark.
Oh, come on.
They glow in the
You're
dark.
You're going to give out apples. You're going to give out quarters. You're going to be the quarter lady.
No. Goldfish. With this economy, quarters not going to do it. Goldfish. They glow in the dark. It's very cool.
Up next, the morning calls, plus Walter Piecyk of LightShed Partners as we look ahead to Apple's earnings after the closing bell. That's next. What is your favorite Halloween item to hand out? This is Bloomberg Surveillance.
The markets seem to not be able to make up their minds one quarter to the next. The market's getting a little bit more spooked on some of the spending intentions. The spending is, I wouldn't say out of control, but certainly prioritized the spending over margin and earnings after a very good period of growth and margin expansion. We're set to maybe enter a period where margins come down and earnings growth slows down into the single digits.
That was Stefan Slowinski of BNP Paribas Exane. Right now, you're seeing markets digest everything in stride, essentially flat on the day, although actually falling quite considerably since earlier, fluctuating around. It's been down to the 0.2% decline. It's been up 0.1%. There's a real question here, the push-pull of no Fed rate cuts, a question around whether the bar is just incredibly high for some of these big tech players. You are seeing 10-year yields continuing to climb, though. Watch this space after yesterday's 10 basis point increase. You are seeing an additional 2 basis point rise this morning. Time now for the morning calls. First up, Oppenheimer downgrading Meta to market perform, questioning the company's significant AI investments despite lacking a clear revenue opportunity. Those shares down 9.5% this morning in early trading. Next up, Wolf Research raising its price target in Alphabet to $350, saying its AI bull thesis is resonating. Those shares up 8.3%. And finally, Wells Fargo raising its target on Microsoft to $700 from the current $529, citing favorable long-term tailwinds. Those shares lower by 2.3% this morning. Sticking with tech, Meta issuing a new debt in a 6-part bond sale. The announcement coming just after CEO Mark Zuckerberg told investors Meta will have to spend even more on AI. Joining us now is Bloomberg's one and only Ed Ludlow. Ed, thank you so much for getting up early for us. I just want to start there. What's your sense of how much more some of these tech giants are going to have to tap the debt markets to fuel some of their AI spend?
Yeah, it's data that I've been tracking really closely. Meta's 6-part is really interesting. The duration ranges 5 years to 40 years, which like at one time, and Lisa, you know this better than me, we'd be like, 40 years, what? That's insane. But it's not unprecedented, even in this portion of the year. If you remember, Oracle did a 40-year note that was 1.37% over treasuries. This Meta one, according to a Bloomberg source, is 1.4%. But it speaks to the imminent capital need and the longer term capital need that Meta has. And, you know, the story from overnight is that capital expenditures in the next fiscal year, 2026, will be notably larger than they are this year at a top of $72 billion. That's the stakes we're talking about.
Ed, do you have a sense of what Meta is spending on, given the fact that they don't have the cloud that, say, the Microsofts or the Alphabets have?
Yeah, this is what spooked the market, right? Meta is not a hyperscaler. And the way to look at it is that its aggressive investments in capacity are in part to meet internal demand, which is also a part of the evidence that the CFO, Susan Lee, is trying to put forward that they're seeing returns straight away. When you bring a new data center online or new capacity online, Meta often has to look within its own teams and say, what's the biggest priority here? That is difficult for analysts to model how it immediately translates to top-line growth, right? And so that's the brinkmanship going on here. Meta's sort of willingness to front-load investment is how Zuckerberg put it, and the visibility of the market to see revenue growth that would justify it, near-term or longer-term.
Bloomberg's Ed Ludlow, thank you so much for taking the time. Look forward to your work later this morning. Sticking with tech, Apple reporting earnings after the closing bell today. Walter Piecyk of LightShed Partners remains neutral on the iPhone maker, writing this: Apple remains behind peers in visible AI progress, yet it hasn't lost users or ecosystem strength. Investors view this as a long game, not an immediate risk. Walt joins us now. Walt, so great to see you. I keep thinking about what you said about the changeover in leadership a while back. What do you expect today, given how high expectations are for the Apple iPhone 17 upgrade cycle that we're getting some positive news on?
I mean, at first I want to pick up on what Ed just said. When you want to compare the $70 billion in CapEx that Meta is investing in, I think that's going like 120 next year. Google, I think, is a $90 billion CapEx number. And Apple's investing like 10. And if we look for innovation at the company, we have to look in the R&D space, which is an expense, right? 35 billion. So much lower in terms of the investment in the AI. Now, as it relates to the upgrade cycle, what we've already seen without these new phones, without the AI, is, you've seen the bottom in the replacement cycle. I mean, if you look at the operators, customers have very old phones that they're now upgrading. And in addition to that, the market's gotten more competitive. You brought up on your Bloomberg, AT&T, Verizon, T-Mobile, these stocks have been getting crushed recently because of the concern of new competition. More competition is good for Apple because you're going to see, as a consumer, more promotions, perhaps lower prices, and this is going to help things. So really in this September quarter, there's probably an opportunity for upside in iPhones, not because of AI, not because of innovation. It's just because everyone's phone is so old. Now, how much that translates to guidance for next quarter, I think, again, if you're looking like over 50 billion in iPhone revenue this quarter, going to 75 billion, maybe you see a guide even higher than that, just given the fact that people are just starting to finally upgrade their phones.
Walter, who's doing it right? I mean, is it Samsung? Is it Google and some of their Pixel products? I mean, who's actually implementing AI in a comprehensive way in a smartphone that you see as a formidable risk to the Apple universe?
I mean, Android, I think, is doing a good job right now. It's just not moving share, right? It's just not relevant enough. Maybe when we move to a more agentic world, when your phone is doing more tasks for you, that gives the Apple user a reason to shift. But it's really the unknowns, right? There's been press, I think, in the past week or so about, maybe the stuff that Johnny says is going to be, Johnny Ives, I'm talking about in terms of his collaboration with OpenAI, in terms of making new products, that maybe it won't be only complementary and there will be a broader suite of products that come out of OpenAI. So it's that risk of new applications, on new devices with this new era of companies that, we've seen, I think in the press recently, OpenAI talking about a $1 trillion IPO. Like, this is a new era. And these are companies that want to diversify themselves across many different, not only services, but actually hardware as well. And that could really be the bigger risk for them versus Samsung just implementing Android's AI a little bit better.
And then in a market like China, they're dealing with China really putting the thumb on the scale with national champions. What's your read out of what's going on with Apple specifically when it comes to Beijing?
I mean, I think at the start of the year, obviously, everyone was concerned with the tariffs in terms of how that would impact the relationship with China. And we've seen, up to $1 billion of impact from tariffs on Apple's bottom line. But, it sounds like, that relationship is improving from some of the early press from the president's meeting last night. That can only be positive for Apple. That always hangs over as a risk. There's a lot of these large risks that hang over Apple, but a lot of them seem to fade away. And the stock has been reflecting that with the PE rising from 25 to 33. Another one is regulatory, right? You have these judges that talk very tough about cracking down on these large companies and these large monopolies. And yet take the Google case, and when you move to remedies, the remedies were very soft. So I think that bodes well for some of the, whether it's that or Trump improving things with China, that bodes well in terms of the risk that hangs over Apple in the near term.
What about Cook himself improving things with Trump? He was with the president this week. It seems that he flew to Japan just to be a part of that business leaders dinner that the president hosted in Tokyo.
I mean, I think Tim Cook has had a longstanding positive relationship with the president. They got a huge ability to repatriate a bunch of cash that was in Ireland at a lower tax rate earlier. Obviously, he's been close with the president. And I think that, again, even if things intensify with China, the ability to have carve-outs for Apple, I think, present certainly an opportunity. And Apple itself has a good relationship with China and the amount of manufacturing that they've enabled in that country. So, as things, improve in terms of our outlook, with China as a country, that can only help Apple and reduce the risk that, as you mentioned, that China puts its thumb on the scale.
Just 30 seconds left. I know you've got a tech crystal ball. We'd love to use it. If you can look into the crystal ball and foresee who the winner of this earnings season is going to be of the tech giants, who do you think it's going to be?
That's a great question. I mean, Google. I mean, if you look at the AI, right? Apple, is the one that's not really delivering AI, right, and hasn't really impacted their business. Same thing with Google, right? I mean, I personally use ChatGPT for all my search, but look at those search numbers that they reported last night, and the outlook that they have for cloud, and now Waymo, which continues to gather momentum. So, I think the story this quarter is not going to define the winners and losers in terms of AI, meaning that search is still at risk for Google. Yeah. iPhones are still at risk with Apple. We can't just say just because one quarter of these companies outperform that means that they're the definitive winners, but maybe in this quarter they will be.
Walter Piecyk of LightShed Partners. The crystal ball is cloudy, but it is getting maybe some clarity, maybe more so after the bell. Walter Piecyk there joining us. Coming up next, Nela Richardson of ADP as markets digest a hawkish Fed rate cut. Plus, Yahaira Anand with your morning movers. Chipotle taking a lot of oxygen out of the morning, down about 18% as consumers pulled back. Is it a Chipotle economy or is it a Delta one? What a load of news, and everyone's just trying to figure out how to get to Halloween. Right now, you are seeing futures lower after earlier being up. Just real fluctuations here as people try to understand whether it is the Fed's non-rate cut in December potentially that should drive things, whether it's big tech earnings that are really good, but really facing off with a high bar. 0.3% decline now on the S&P. You are seeing yields creeping higher. Now we are at a clean 4.10 on the 10-year Treasury yield after yesterday's 10 basis point rise. Really interesting to watch. Meanwhile, watch this. Meta shares markedly lower after their earnings. People concerned about their spending plans, down 9.3%. Talking of spending, they are in the market currently with a $25 billion bond sale at least as they try to capitalize on a wide open debt market for tech debt at a time when they are spending really rapidly. More on that later. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. It was an outstanding quarter for Alphabet, sending shares up 8% now in the pre-market. The Google parent beats across the board, with revenue topping $100 billion for the first time, while net income up 33% from a year earlier. All this thanks to growing demand for its cloud and AI services, giving investors confidence that its massive spending on AI is paying off. And we move on to Chipotle. Those shares are falling now 18% in the pre-market after the burrito chain cut its outlook for the third time this year. The company says diners are pulling back, especially those with lower income. So Chipotle says it's going to take a very cautious approach when it comes to any price hikes. And we end on Crocs. Those shares are up 6.8%, though they have been down this year 23% through yesterday's close, but they handily beat on revenue and adjusted EPS. The strong results were fueled by growth beyond its famous clogs and reduced discounts, plus growth in international markets were able to offset a slowdown here in North America. Lisa.
Thank you so much, Yahaira. I know you've got strong feelings, AMH. Come out with them. Let's go.
I just don't understand. That's it.
Okay, that's all you're going to do? I think it's great. Good job. Go Crocs. Turning now to the Fed. Following the decision to lower interest rates for the second straight meeting, Fed Chair Powell casting some doubt over a potential cut in December. Bloomberg's Michael McKee was in the room. Mike, what everyone keeps taking away is that they are absolutely not a done deal. It's not a done deal when it comes to a December rate cut and the fog getting thicker. What's your takeaway? Do you think that there's some nuance here?
Yeah, pick your own kind of metaphor for where the Fed is and where everybody else is on the economy right now, which meant that some of what Jay Powell had to say didn't really hang together. But the point was, the Fed doesn't know enough about what's going to happen to the economy to say for certain that it wants to cut rates again in December. And obviously, they're pretty divided over this. Now, you look at what Powell had to say about the economy and also from the statement. He says 4.3% is a low unemployment rate, and yet the labor market is what they're worried about. Inflation has moved up. Annual PCE, he said, extrapolating from the CPI numbers, is 2.8%. That's an increase. And growth is somewhat firmer trajectory than expected. So the Fed doesn't necessarily have a case for cutting, a strong case for cutting at this point. And the key quote that I took away from this came late in the news conference, one of his last answers, when he sort of stumbled over this answer. If we do wind up resuming rate cuts at some point, we will, but at some point, that if they're doing an awful lot of work, I think that you could pretty much assume that at this point, there's at least a half of the voters who would say, let's not go forward with this. So what do we have coming up? December 10th is the next Fed meeting. What kind of data will we have before then? That's going to be very important. In December, Trump says he's going to nominate a new chair. Then we've got a couple of Fed meetings before the end of Jay Powell's term in May. So Powell's going to get 4 more meetings to guide us. Stephen Myron's term ends January 31st. We're assuming whoever the chair designate will be is going to be nominated and probably confirmed by them. So we'll have a little bit of change in the makeup of the Fed. And we'll also see whether the data suggests that additional cuts are necessary. We know that the president's going to say that, but is the data going to tell them to do the same thing?
Mike, great to hear from you. Great work yesterday. Thank you so much. Bloomberg's Michael McKee coming to us following that press conference yesterday. Let's stick with the economy and the Fed. Nela Richardson of ADP joins us now. Nela, wonderful to speak with you. ADP very much in a new and prominent spotlight, and we'll get into that in just a second. What do you think the Fed's reaction function is heading into the December meeting? What could actually tip the scales about whether they cut that 25 basis point or not?
You know, they're threading a very fine needle between their two mandates, and it really will be a pulse check, and I think a lot of anecdotal evidence from the different Fed banks on what's going on in the economy. They are going to have a listening device to Main Street to really hear what's going on at the street level. They're not going to be able to see this aggregated picture and a regular indicator. They're going to have to go to Main Street and really find out what small businesses, what workers, what consumers are doing on the ground level to make this decision. And that might be new to put such a priority on the anecdotal evidence.
Is there a cohesive story coming from Main Street? Right now, if you take a look at earnings, you're seeing some layoff announcements that are pretty considerable. Mm-hmm. You're seeing a real fear about not being able to get a new job. You're seeing this with the quits rate. Are you seeing something that really is flashing a big red signal that should prompt the Fed to cut rates further?
No. You know, big companies, they drive the headlines, but small companies drive hiring. And if you look at the statistics, you'll see that about 3 in 4 Americans work in a company that has less than 250 employees that are not making the headlines in terms of their hiring decisions. And that's why we thought it was really important at ADP Research to give you some real-time information. We, as you know, released this NER Pulse, National Employment Report Pulse, on Tuesday to show you in real time as payroll gets, what's going on at the street level, at the Main Street level. level. So you can look at the aggregation of small firms, medium-sized firms, and large firms, and how it's hitting in the economy right now. Because all of this information, whether it's coming from anecdotal evidence, official statistics, or private sector data, has to be part of that portfolio in a complex economy like the one we're in right now.
So it sounds like you're still seeing stasis of low hiring, low firing.
That's certainly true. But that stasis, Annmarie, what's interesting about this moment for me is that usually when you see a slowdown in hiring momentum, the why isn't important. You just see it slowing, and the Fed acts to make sure it's stable or maximal given economic conditions. Now the why matters so much because we're seeing a multi-layered impact on the labor market. We're seeing AI transformation being announced in these large layoff announcements. We're seeing demographic changes in this aging U.S. economy. We're seeing the fluctuations of short-term business cycle dynamics. Which one of those is causing a slowdown in hiring momentum from earlier this year? It is unclear. All we can do is understand that it's happening and at the pace and momentum it's happening. And that's where ADP stepped in and to provide this weekly pulse of labor market employment.
Where do you think it is really coming from? Because how does the Fed address AI-induced labor market weakness?
This is the hard part. Some of these changes that we're seeing in the labor market are structural. They are long-term and enduring. Other changes are short-term, short-lived, and we saw that. Last month, September, ADP reported a 32,000 decline in jobs. You can see in this new NER pulse an upward momentum that looked to be a short-term trough, and now things are building back to maybe something more palatable, but definitely not where we were at the beginning of the year. We reported an average job gain over the 4 months of about 14,000 jobs. So that's a run rate of about 55 to 57,000 jobs. These are preliminary numbers. It's a preliminary estimate. It could change next week, and that's how fast things are moving, that we have to really pay attention to the flow of jobs in and out and all these structural and cyclical changes coming.
I'm struggling to put together that kind of number, which would suggest actually a negative job growth, right? I mean, it would essentially be, yes, you are getting job growth, but it's not enough to be a replacement in terms of people exiting the market. And this really does start to raise questions about the strength of the market. And yet you're saying you don't see that really as a key flashing warning sign. You don't see a truly weak labor market. What would you have to see to really change your view?
Right now we're at a place where the stock is pretty good, right? We're not seeing a lot of layoffs, and we still get that data at the state level in terms of initial jobless claims, and we're not seeing a lot of hiring. So overall, we're still in this place of stasis, which is long-term eroding the dynamic strength of the labor market. But in the short term, it's not raising any big red flags. And that's what's hard for the Fed. They're in the muddled middle. It is clear that inflation is higher than they'd like it to be, and that the labor market is weaker than they'd like it to be. And there's no easy answers because their tools are meant to be in the short term. And yet we may be undergoing a structural transformation in the labor market.
So let's talk about the structural transformation. We're going to get Amazon earnings after the bell, and there's this expectation that they're going to talk about some of the layoffs they're planning. And they've been pretty vocal about artificial intelligence and what that will do to their workforce, hopefully, in their mind, to shrink it. We've talked about this before. Is there any new insight you can bring to just how much the advent of AI and the proliferation of ChatGPT, et cetera, has really contracted job opportunities in certain subsets, not just new college grads?
This is one of the reasons why we launched this pulse. It wasn't just about the business cycle. It was about the AI transformation that we think needs to be measured. In fact, I'm going to be on a webinar with our partners at Stanford Digital Economy Lab talking about this very issue, the impact of AI on the labor market. Clearly, it's having an impact. We've talked about early career being the most vulnerable in AI-exposed fields. But I don't think it's going to be one note, and I don't think it's going to be one impact, that will have a evolving impact through different sectors, different occupations, different demographics. That's why it's so important that we try to measure it and capture it in real time instead of after the fact, so we can actually guide policy hiring decisions towards the eventuality of what is hopefully a more productive labor market.
Nela, we're 30 days into the government shutdown. We still don't have BLS data. So we're all lucky that we have your data. Can you just give us an update? Is the Fed now getting data again? Are you guys talking? Is there a collaboration?
What's great about what we did on Tuesday is everybody's getting this data. It's at a weekly frequency. It's available to all 8:30 a.m. every Tuesday, except when we're doing the National Employment Report. That was our goal. That is our mission at ADP Research, is to make this data available to all. And I think, yes, the Fed can see it. You can see it. Lisa, you can see it, and we can have a discussion about what it means for the economy.
Nela, always wonderful to catch up with you. Thank you so much for your insights. Nela Richardson of ADP there with real-time data coming out of that organization. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. President Trump has said, quote, he had an amazing meeting with Chinese President Xi Jinping that resulted in a trade deal that would have fentanyl-related tariffs on Chinese goods effective immediately. Trump also said China has agreed to buy U.S. soybeans again. On a scale of 1 to 10, the president says he'd rate the meeting a 12. Meta is looking to raise new funds in a 6-part bond sale. Sources telling us here at Bloomberg the company is looking to raise at least $25 billion in debt. The news comes just after CEO Mark Zuckerberg warned investors that Meta would have to spend even more on AI. According to a company filing, proceeds would go toward general corporate purposes. Shares of Roblox falling in the pre-market even after the company reported its best quarter ever, with daily active users beating analyst expectations. The video game company said CapEx will likely be flat between this year and next. It's also facing lawsuit allegations that it failed to sufficiently protect young people on the platform. And coming up on BTech at 11 a.m. Eastern, Ed Ludlow and Caroline Hyde will be speaking to the Roblox CEO. That is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie, and thank you so much for this morning. Up next, setting you up for the day ahead. Plus, Kelly Kowalski of MassMutual as Fed Chair Powell puts a December cut in doubt. Is it really in doubt? This is Bloomberg Surveillance.
I don't think it was at all surprising. The two dissents could have been a bit more interesting. I think Myron could have gone for 75 basis points. After all, he wanted 50 last time. Sure. So there's 25 that he's owed, plus another 50 this time. That would have been fun. And Schmidt, where was he last meeting? Where was he last meeting? Now you've had more evidence that the labor market is feeling a bit spongier and inflation's not as much of a threat as we thought back in September, and suddenly he reemerges. To me, it tells me that Powell is losing his grip on the Fed.
That was Bob Michael of JPMorgan Asset Management with the key point that a lot of people kept pointing to, which is this is not a Fed Chair Jay Powell that can represent a consensus, because the consensus doesn't exist. Counting down to the opening bell, we are looking at a host of different data points. Here's the trading diary for the week ahead, 9:15 a.m. We do get an ECB rate decision followed by a news conference from President Christine Lagarde. Then after the closing bell, earnings from Apple and Amazon. Friday, we get earnings from Exxon and Chevron, which will be especially interesting given the AI build out, as well as the potential deals the U.S. is striking internationally for exports. What you are seeing in markets is that softness continuing to build. The S&P down, futures down about 0.3%, a little bit more than that as the session grows older, and the bond sell-off does continue with yields just marginally higher. That 10-year yield now at 4.10. Turning back to the Fed, Chair Jay Powell emphasizing two-sided risks and warning investors to rein in December rate cut expectations. Kelly Kowalski of MassMutual writing this: it's ultimately encouraging that the Fed and policymakers are responding proactively and operating in a risk management mode. Kelly joins us now. Kelly, you found this meeting encouraging. Let's start there. That's actually not what most people seem to say.
So we actually had that view ahead of this meeting. So I will say that, similar to the market, we did find the hawkish stance a little bit surprising. I think what we really saw was we expected this at some point, right? We knew the Fed was going to cut a few times and then take a pause and reassess. I don't think we expected it this soon, especially if you see the current market pricing, which is still at 70% for December.
At this point, though, we're not necessarily seeing a reason for them to be cutting aggressively, right? We were just talking to Nela Richardson of ADP, and she said she's not seeing a labor market that's falling off a cliff. When you take a look at inflation, it's still at about 3% where it's been, above that 2% target for the past 5 years. Isn't there a concern here that they're prioritizing the wrong risk?
I think that if you look at the trend in the labor market is a weakening, right? We haven't seen quite an inflection point in terms of, again, the jobs market data falling off a cliff. And if you look at the inflation side, we've got an acknowledgement from the Fed that, tariffs are a one-time shock and that without tariffs, they're close to their mandate. So along those lines, there is a valid question as to, why not do one more insurance cut if we are concerned about these downside risks to the labor market?
Do you think they could move in December if the government stays shut?
I think that Chair Powell's comments was a little bit of a warning that if we don't get data, maybe they will pause. And we may get some noisy data with the government shutdown, right? You could see, data that has exceptions because of what's going on with the government. So I think that was a bit of a warning there. And we may get data that's kind of doesn't show us one way or the other.
Well, Lisa mentioned this. Is it really placating hawks, or is he sending a message to Congress?
I think it is more he is trying to represent the range of views on the committee. You look at the dots for year end, we kind of knew going in that there was such a wide range of views. And I think it was, speaking to those, wide spectrum across the committee.
At this point, we saw the disappointment, the shock, the awe that maybe December wasn't a lock. And you're seeing markets, yes, they are futures marginally off this morning, but you're not seeing a mass freak out. It's not as though that's going to somehow take away the candy that the market's been riding on ahead of Halloween. I'm just wondering, even with the potential for the Fed not to move in December, are you really concerned about risk assets? Do you really see any catalyst to drive a real pessimism at a time where everyone seems to feel like they're Teflon?
I think that for the markets, this was, outside of interest rates, which we did see a big pop, wasn't really a huge event. I think it's earnings and fundamentals are really more front and center. And the concern would be that if you did see a deterioration in the economy and the Fed didn't move, but I think risk assets have a confidence, right, that the Fed will take the right action should those things happen.
So let's talk about earnings. We got earnings from Hershey's and ahead of Halloween, and we know that Annmarie is the person who does hand out goldfish and not chocolate.
My mom's handing out real size, not that fun size Hershey bars.
Okay, well you can post her address afterwards on your X page. But there is this question here: what are we seeing? We're seeing people are buying less candy, they're buying less chocolate, they're pushing back with Chipotle with some of the higher prices, so they can't really pass along the costs that they're seeing in their inputs. What are we learning from earnings?
We are seeing underlying economic resilience, but we're also seeing a validation of the trends that we already know are in place, like the K-shaped consumer. The real question is this K-shaped consumer, is it going to break us? Are we at that inflection point yet? We look at credit markets. We've seen subprime delinquencies, continue to go up, but overall, it hasn't mattered much. That is something that we continue to watch, but it's really, sort of telling us what we already knew has been going on in the economy.
So how are you positioning heading into year end? Is it a pain trade still to the upside, or are you looking for the potential of more cockroaches coming out in their Halloween outfits?
Well, we really look at credit spreads, right? At MassMutual, we're primarily credit investors. And I think outside of geopolitics, the way earnings are coming in, and geopolitics as of this morning are trending in sort of a stable direction. It's hard for us to kind of see a downside catalyst, especially because we know how much capital is out there, waiting to get deployed despite, these elevated valuations.
John said this the other day. It feels like it's the end of the year this week. I mean, it felt like there was a whole year, as you said, in this week. But yeah, it feels like it's almost the end of the year. 2026 is going to be interesting, though. What kind of catalyst are you looking for?
It is, on the monetary side, we have had rates coming down. That is sort of, we'll still count that in the tailwind category. On the fiscal side, right, we're getting incremental consumer stimulus from the tax policy, and some of that corporate stimulus still has to work its way through. I think the real question is right now where we are with the labor market, where we are with the consumer. Is this sort of a soft patch, or might we see that reacceleration into next year? And maybe that's what the Fed was thinking about, that this could sort of be a temporary soft patch, and they want to be cautious into that potential improvement.
Would it be a reacceleration because of the fiscal coming out of Washington, the one big beautiful bill, some of these rebates individuals might be getting?
I think that could be part of it, but I think you really have to see a broadening also of economics, different sectors contributing to the economy, right? We know it's a rather narrow economy. You might have to get some help, for example, from housing and from manufacturing, for example, which has been in just a rather dismal place.
Kelly Kowalski, thank you so much for being with us. Have a wonderful weekend. I know it's only Thursday, but you brought it there. You were talking about the end of the year. Kelly Kowalski of MassMutual. I got to say, this week is really stacked up to be a quite tremendous bastion of news and information. And we're left kind of in the same place, which is that AI is not a bubble, but at the same time, people are worried about overspending. The Fed is in a foggy, unclear place, but a lot of people still expect them to cut rates. And to the degree that international pressures continue to mount, there is this stasis that has taken hold, and there doesn't feel like there is a true escalation in the trade risks as people felt earlier this year.
No, and there's no de-escalation exactly. This just feels like a détente for a year. You can punt this story for a year when it comes to China. Everything we thought going into it is what we got out. A few questions on maybe energy and Blackwell, but overall the market is just breathing an exhale when it comes to China. I think what's more interesting is the Fed. They give something away in this rate cut, but they take it back when they're talking about the fact that December is not a foregone conclusion. Far from it. Those words really is what shook the market yesterday.
Next up, Apple and Amazon with a read on the consumer, a read on the tech build out, a read on cloud, and a real read on the spending that some of these big tech players are spending. Coming up tomorrow, don't miss this. Peter Scheer of Academy Securities, Dan Ives of Wedbush, former Trump White House trade official Kate Kalukowicz, and Jim Caron of Morgan Stanley. Good morning. This was Bloomberg Surveillance.